Next, in consolidation, we are going to discuss Accounting Standard 27, Financial Reporting of Interest in Joint Ventures. See, in consolidation chapter, AS 21, which talks about consolidation of subsidiary, we have already covered. AS 23, consolidation of associations, we have associate companies, we have covered. Next, AS 27, which is talks about consolidation of joint ventures. Now we are going to cover this topic, especially from consolidation point of view. Financial reporting of interest in joint ventures. Now first, let us try to understand what is joint venture, because here we are predominantly talking about our interest in joint venture. So let us try to understand what is joint venture as per AS 27. Sir, basically in layman's language, what is joint venture? Can you help me? What is joint venture? Sir, when two or more parties they join together to execute any project. So to complete any project, if two or more parties are working together, basically that is called joint venture. Joint means two or more parties. Venture means a project, a contract. That is called joint venture. Now, this is very common. Companies, they will join together to execute different kinds of projects. So when they have a joint venture to execute any particular venture, how accounting will be done? That is what we are going to discuss in this standard, or why AS 27 came to address this issue. When you have any joint venture, how the financial reporting will be done? Okay, but see, we understood what is joint venture in layman's language. But what is joint venture as per AS 27? That is important here. So in the AS 27 itself, they have given a definition of joint venture, very, very important. Because first of all, to say this is a joint venture, it has to satisfy definition as per AS 27. Then only we talk about our accounting treatment for investment in joint venture. So if it is not basically joint venture as per AS 27, so where is the question of application of AS 27? So that's why we need to understand whether it is a joint venture or not. Okay. Now, look at this definition. In the definition section, the first definition they have given is joint venture definition. Now the standard says joint venture, a contractual arrangement where two or more parties working together on an economic activity under joint control. Say this. So if you observe this definition carefully, sir, four key terms are there. First, there is a contractual arrangement. Second, two or more parties work together. Third, for an economic activity. Fourth, under joint control. So let us try to understand each word carefully here. First, to become a joint venture, what are the essential conditions? These four things only I have given here. First, there should be a contractual agreement between the parties. So whenever two companies wants to execute any project together, generally what they will do, they write an agreement. This is very common, right? When two parties want to do business together, in order to avoid future complications, generally they will write the terms and conditions in the form of an agreement. Even in case of partnership firm, it is the ideal situation is what the partners has to they will write a partnership deed. Similarly, companies will write MOUs, AOUs, articles of association, memorandum of association. Similarly, in case of joint venture also, there should be a contractual arrangement. So there should be an agreement between the parties. The relationship is governed by written agreement, which can be an official document, meeting minutes, or any written form. So this contractual agreement can be in written form. Maybe we will write the minutes of the meetings. Any written form is okay. Second, there must be two or more parties who is working together. Can be individuals or business entities. See, these parties can be an individuals or can be business entities like AOP, BOI, company, firms. Maybe two firms together, they can start a venture. or two companies together, they can start a venture, or AOPs, Association of Persons, Body of Individuals, anybody. Can be two individuals also, can be two business enterprises also. There is no restriction, absolutely. Most important thing, there should be an economic activity. Sir, why these two parties are joining together for an economic activity? Economic activity means an activity which is done to earn some profit. Suppose if it is a service oriented activity or activity which does not give you any profits or benefits, then there is no joint venture. For example, two business entities have started a venture for doing any kind of service which does not involve any commercial activity, which does not done for any profit purpose, profit motive, then there is no economic activity, then it cannot be a joint venture. So the venture is separate from the regular business of the ventures and aims for profit. See, this is important thing. There should be an aim for profit. If it is a non-profit oriented association or venture between the parties, that cannot be called as joint venture. It may have a separate legal entity, nothing wrong. And one more thing I told you is under joint control. This is also very, very important. Sir, what is this joint control? See, the venturers. Venturer means the parties who are joining together to execute a project are called venturers. Now, these venturers can influence the financial and economic decisions, financial and operating decisions of the joint venture, and also share the outcomes. That is called a joint control. So, joint control means venturers influence operating and financial decisions and share the outcomes. How can they influence operating and financial decisions, sir? So, suppose if in case of a company, how can I influence a decision? By having shares. If I have a shares, I can vote in the meeting. So through the voting, I influence the financial and operating decisions. Similarly, in case of a joint venture, the venturer can influence the financial and operating decisions of the joint venture business. So that is called joint control. Very, very important, sir. Sometimes there are some investors in the joint venture, sir. They have investment, but they does not have joint control, because the standard says what is joint control. Joint control means venturers must influence operating and financial decisions and share the outcome. Suppose I invested in a joint venture. I'm a venturer, but I does not have joint venture. I does not have joint control. Why? Because the word joint control means I must able to influence operating and financial decision. Okay, see this investor in a joint venture. See, venture is different from investor here. Important thing, sir. See, for example, look at this. There are two entities, sir, here, A Limited, B Limited. Now, suppose they want to form as a joint venture to execute a project. Now, in this case, A Limited is venturer, B Limited is another venturer. Now, in this joint venture, the operating and financial decisions this A Limited and B Limited can influence, and they can share the outcome of the joint venture also. So then we say these venturers are having joint control. Suppose, for example, there is a party, another party, for example, C Limited or Mr. C. He have investment in joint venture, but he without having joint control, because he cannot influence the financial and operating decisions. He cannot share the outcomes. Then in such a situation, sir, he will be called as investor. Investor in joint venture means a party in joint venture, but without joint control. So understand the difference between venturer and investor. Basically, venturer means what, sir? Venturers influence the operating and financial decisions. That means venturer means basically prima facie is having joint control. Investor, when we call investor of a joint venture, means he is having investment without having joint control. But that means he cannot influence the financial and operating decisions. So these are the four important things, sir. So tell me, to become a joint venture, first there should be what? Contractual agreement between the parties. Second, two or more parties, they formed work together. They can be individuals or any other business entities. Next, for economic activity, see, these parties are joining together to conduct an economic activity. If there is no economic activity, there is no joint venture. And what is the last one? There should be joint control between the parties. So joint joint control. Joint control means the venturers can influence the financial and operating policy decisions of the enterprise. So that is what they have given here. So what is joint control? Control shared contractually over an economic activity. Control basically means power to govern economic activity in the financial and operating policy. Who is venturer? A party in joint venture that has joint control. Investor means a party without joint control. Of course, proportionate consolidation. I'm going to explain that. So these are the important things you need to understand about joint venture. So tell me the conclusions, the important conclusions. To become a joint venture, first there should be what? Contractual arrangement between the parties. Contractual arrangements between the parties. Second, two or more parties should be there. Two or more parties who is joining together for what? Economic activity. And there should be joint control. Okay. Now, venturer generally means what? He is having joint control. Investor generally no joint control. Okay. So we understood what is this joint venture as per AS 27. Now the most important thing, sir, AS 27 says this joint venture is classified into three broad categories. Okay, we understood what is joint venture. Now the standard says this joint venture can be classified into three broad categories. One is joint control, jointly controlled operations. Second one is jointly controlled assets. Next, jointly controlled entity. So there are three forms of joint ventures. So joint venture can be a joint control operations, JCO, joint control assets, JCA, joint control entity, JCEs. Okay. Now we need to understand when a joint venture will become JCO, when a joint venture will become JCA, when a joint venture will become JCE. And then we need to discuss about the accounting treatment for each case. That's it. This standard will be done. So see here, types of joint ventures. Joint ventures can take different forms and structures. See, the joint venture, depending upon the agreement between the parties, it can take form in different shapes, different structures. But we can't cover all the forms and structures. That's why the standard broadly classified three broad types. One is jointly controlled operations. See, concentrate on this word operations, because the common thing is what? Jointly controlled. One is operations, second jointly controlled assets, third jointly controlled entities. So assets, entities. Okay, now let us try to understand each one. First, jointly controlled operations, then jointly controlled assets, then jointly controlled entities. First, so we are discussing the forms of joint ventures in Accounting Standard 27. As I already told you, Accounting Standard 27 broadly classifies joint ventures into three categories: jointly controlled operations, jointly controlled assets, jointly controlled entities. So JCO, JCA, JCE. Now let us try to understand each one of them. First, I am going to discuss jointly controlled operations and jointly controlled assets in a comparative manner so that you can understand this concept better. Jointly controlled operations as well as jointly controlled assets. Okay. Suppose, sir, there are two entities, A Limited, B Limited. Now, if both of them together, they want to undertake one joint venture. Now, A Limited is called what? Venturer. B Limited is another venturer. So, both of them together, they have started a joint venture. Now, when this joint venture is known as JCO, jointly controlled operations. See here, what happens is A Limited, B Limited went into an agreement. Agreement for what is, we will jointly operate this particular activity, or we will jointly operate this particular business. And A Limited will brought its own assets. It will use its own assets or resources for the joint venture purpose. B Limited will brought its own assets and resources. So A Limited, B Limited brought their own assets and resources, and they will use it for joint venture, and whatever the expenses incurred for this joint venture or whatever the revenue generated from this joint venture, these expenses and revenues will be shared between the venturers in agreed ratio. So there is an agreement, right? According to that agreement, how the expenses will be shared, how the revenue will be shared, in the agreement they will specify. Accordingly, they will share. So understand jointly controlled operations. When we call jointly controlled operation, a joint venture is classified as jointly controlled operations when venturers, okay, want to do a particular project jointly. Of course, here no new entity is formed. See, this joint venture cannot be called as a new entity. Here no new entity is formed. A Limited, B Limited, together they have started. They decided to do one project. And A Limited will use their own resources or their own share of assets. B Limited will use their resources or assets. And with their own assets and resources, they will do this joint venture. And ultimately, whatever the expenses they are going to incur for this joint venture, whatever the revenue generated from this joint venture, that they will share as per the agreement. So this is basically jointly controlled operations. No new entity will be formed, and agreement is to conduct any operations jointly, and expenses and revenues will be shared in a agreed ratio. These are the main things. Okay. Sir, what about, this is jointly controlled operations. What about jointly controlled assets? Jointly controlled assets. See this. In jointly controlled assets, what happens is, suppose there is A Limited, there is B Limited. Now A Limited, B Limited jointly had some assets. They have asset, joint asset. See, they want to construct and maintain this asset. So they formed a joint venture. Here the understanding is that, see, we will construct one particular asset and we will maintain this asset. And by using this asset, we'll try to generate some revenue. So there is a joint assets. This asset under the joint venture belongs to both of them, A Limited, B Limited. So they will share assets here. And here, one important point, sir, whatever this asset generates, sir, the output. Basically, this output will be taken by the venturers and they make their own sales. So therefore, whatever the revenue generated, it cannot be shared. This joint asset will be shared, and from this joint asset, basically what happens is output will be generated. This output will be taken by A Limited and B Limited. They make their own sales, so they can share their own revenue. One more important point here is expenses. See, whatever the expenses they are going to incur to maintain joint asset, that will be shared between the parties as per agreed ratio. This is the most important thing, sir. So in case of jointly controlled assets, understand the wordings. Jointly controlled assets, venturers has a common asset, joint asset, and they need to maintain this asset. To maintain this asset, whatever the expenses they are going to incur, that will be shared by them on the agreed ratio. Okay. And here also no new entity is formed. Joint venture cannot be termed as a new entity here. So understand here, see this, look at this. The first point you see, JCO, JCA, same point, no new entity is formed, no new entity is formed. No new entity, sir. Here joint venture cannot be called as a new entity. They want to do a project together, that's it. This is a kind of a venture for them. There is no new entity. They are not forming any new entity here. Next, most important point is this one. Agreement in jointly controlled operations, the agreement to jointly carry on operations to earn income. So they decided that we both together we carry on this particular operations and our object is to earn some income. For example, in the first example, A Limited, B Limited, they want to do construction project. So we will construct one big commercial complex, both of them together, and this commercial complex we will sell. The flats in that we will sell, and whatever the revenue generate, we will share between them. Whatever the expenses is there, we will share. So this is basically JCO. See, in JCO, the concept is what? Agreement to jointly carry. Agreement to jointly carry on operations to earn income. But in JCA, what happens here? Here the agreement to jointly construct and maintain asset to generate revenue. So the fundamental difference in JCO and JCA is, in JCO, as a venturer, my assets are my own assets. My own assets, and other venturers has his own assets. Now these assets they are going to utilize for a particular operation, right, to earn income. But in JCA, they are common assets. Both the venturers, they construct one particular asset, or there is an asset which belongs to both of them. This asset they will use to generate revenue. So understand the fundamental difference here. Agreement to jointly construct and maintain an asset to generate revenue. So what happens here in JCO, each venturer has its own assets. Each venturer has its own assets. He will use his own assets, resources for the joint venture. And here in JCA, assets are jointly owned by the entities. See, jointly owned by the ventures. That's the main difference between them. Assets are jointly owned by the ventures. Hope you understand the concept now. And the last point, the most important point here. See, in case of JCO, all expenses and revenues are shared in agreed ratio. Relating to this joint venture, whatever the expenses, whatever the incomes are there, they will share it by both of them because it's a jointly controlled operations. But in case of jointly controlled assets, only the expenses relating to joint assets will be shared in agreed ratio. See this, only the expenses on joint assets are shared in agreed ratio. To maintain this joint asset, for example, there is an asset, there is a building, or they have one plant and machinery. Now, to maintain this plant and machinery, every year 5 lakhs cost will be incurred. Now, this 5 lakhs cost will be shared between both of them, both the ventures. Here, only expenses on joint assets are shared in agreed ratio. Only expenses. Understand the difference. In case of jointly controlled operations, expenses as well as revenue will be shared in agreed ratio. But in case of jointly controlled assets, relating to the joint assets, whatever the expenses incurred, sir, those expenses are shared in the agreed ratio. Sir, what about remaining expenses? Remaining expenses of the joint venture. Remaining expenses respectively, whatever they incurred, they will record. What about revenue? Revenue also I told you, in case of jointly controlled assets, basically what happens is, from this asset, whatever the revenue generated, they will take out the output, and this output, they will make their own individual sales. So the revenue is whatever the amount they make the sales, that they will recognize. Okay. So this is the basic difference between JCO and JCA. So that is what I have given, sir, here. You see in the notes, sir, the final difference I have given, and I will share these notes also with you, so you can use these notes, you'll understand it better. So say this. So future jointly controlled operations, jointly controlled assets. Asset ownership, tell me, in case of jointly controlled operations, every venture has its own assets. Venturers use their own assets. There is no common assets. In case of jointly controlled assets, venture jointly owns the assets. So there is an asset, they jointly owns it. And what is the purpose here? Agreement to carry on operations to earn income. Here, agreement to jointly construct and maintain asset to generate revenue. So understand the basic difference. Here we are together to conduct a particular operation to earn revenue. But here we both construct an asset and we will operate it to earn revenue. Revenue and expenses, for example, both revenue and expenses are shared at agreed ratio. But in case of jointly controlled operations, assets, only expenses on joint assets are shared at agreed ratio. So this is the most important point. Okay, so I explained this jointly controlled operations as well as jointly controlled assets. Now next, sir, jointly controlled entities. See, what is this jointly controlled entity? When we called a joint venture as jointly controlled entity, here new entities formed. Actually, in jointly controlled operations and jointly controlled assets, I told there is no new entity is formed. Okay, no separate entity formed. But in case of jointly controlled entity, we say, when we say joint venture is a jointly controlled entity, is so venturers create a new entity. So this new entity specifically for their joint venture business. So specifically for the joint venture business, they started a new entity. Okay, that is called a jointly controlled enterprise. Here key features also same. A contractual agreement grants joint control over the entity's economic activities. Venturers pool resources and the new entity independently purchases the assets, creates liabilities, incur expenses and generate revenue. Profits and losses are shared based on agreed ratio between the parties. Each venturer contributes cash resources recorded as investments in their separate financial statements. The jointly controlled entity maintains its own accounting records. The entity prepares and presents financial statements like any other enterprise following applicable standards. Of course, I'm going to tell you the accounting treatment, but understand the fundamental difference. So, JCO, no new entity. JCA, no new entity. JCE, there is a new entity formed for joint venture. Okay. For example, you see A Limited, B Limited, both infrastructure companies, they form AB Limited to bid for a 2000 crore metro project. A Limited is responsible for machinery and equipment. B Limited manages and controls the funding. Revenue and expenses are shared in 60-40 ratio. AB qualifies as jointly controlled entity because you need to see new entity formed or not. Yes, AB Limited formed. And I have also given some examples relating to JCO and JCE in my notes here. See this example for JCO. For example, sir, there is Mr. A, Mr. B, Mr. C. Now both enter into a joint venture for construction projects. When we call joint control operations, say this, they form together to conduct one particular activity. Mr. A deals with tiles and marbles dealer. Mr. B building material and materials dealer. C is promoter. Now Mr. A supplies tiles and marbles. Mr. B supplies other building materials. C oversees the construction. They share profits and losses as per agreement. No separate staff, resources, accounts are maintained. Each venture records only their transactions in their individual books. Of course, accounting treatment I am going to explain. This is the best example for JCO. Now, when it comes to JCA, see this. A Limited, ABC, BP Limited and HP Limited operate an oil refinery. They have a common asset. and have common customers, sir. So this is decide to jointly construct and maintain this pipeline. So they agreed to share the construction and maintenance cost 3:3:4. I told you, now, joint cost, expenses relating to the joint assets, that is joint expenses relating to joint assets, they will share in agreed ratio. Pipeline usage time is divided into 4:3:3. That means the revenue accordingly they will share. Okay, so this is jointly controlled operations, jointly controlled assets, jointly controlled entities. Okay, so I explained three, and accordingly you need to understand the accounting treatment also. Now I am going to explain the accounting treatment in case of JCO, JCA, JCA, and we will solve some question. Next, in accounting standard 27, we are going to discuss the accounting treatment for different types of joint ventures. As we already know, sir, AS 27 broadly classifies joint ventures into three categories. One is jointly controlled operations, another one is jointly controlled assets, the last one is jointly controlled entities. Now let us try to understand the accounting treatment of each form of joint venture. First, jointly controlled operations. Sir, basically in jointly controlled operations, sir, we are going to prepare consolidated P&L account. Consolidated P&L account. And in the individual books of the joint venturers, we are going to prepare joint venture account. In order to have control over joint venture activities, they will prepare joint venture account. Okay. Now, sir, why consolidated balance sheet is not prepared, sir? First of all, what is the crux of jointly controlled operations? No separate entities formed, and there is an agreement between the parties to execute a project together for earn some profit. And here there are no common joint assets for the venturers. Each venturer will have his own assets, resources. He will use it for joint venture, and whatever the expenses incurred in the joint venture, that will be shared between the venturers in agreed ratio. And also whatever the revenue earned in the joint venture, that will be shared between the venturers in agreed ratio. That is what the main crux of this jointly controlled operation. So here consolidated balance sheet is not required. Why? Because there are no common assets for the joint venture. Each venturer will have his own assets and resources, and he will use it for his joint venture. Okay, and here in the venture, in case of jointly controlled operations, they will not maintain any separate accounting records for joint venture. Even if they maintain, that's only for internal control purposes. So generally in their individual books, they will write the entries relating to this jointly controlled operations. And when it comes to the accounting part, in case of JCO, what happens is we will prepare consolidated P&L account. And then in the individual books of the venturers, we are going to prepare joint venture account. Why joint venture account is prepared? In order to have control over joint venture activities. See, as a venturer, I want to know what happened during their relating to this joint venture activities. For that, we are going to prepare a joint venture account. It's more kind of a control account we are going to prepare it. Of course, let us try to understand how to prepare this consolidated P&L account. First, you take the credit side, sir. Usually on the credit side of the P&L account, you have incomes, revenues, right? So first take the sales. And when it comes to the sales, sir, what will be the sales on account of venturer 1? What will be the sales on account of venturer 2? Suppose there are two venturers, A and B. Now they join together to form a joint venture to execute one project. Now suppose what will be the sales done on account of A, what will be the sales on account of B? You present it like this. And similarly, goods taken over. Another item in the consolidated P&L account is goods taken over. Sir, what is this goods taken over? See, from the joint venture, if any goods are taken over by the venturer, so venture point of view, that is also a kind of a income, revenue generating transaction. So that has to be presented. That is also venture wise. So how much is taken by venture 1, A in this example, how much is taken by venture 2, that is B in this example, you make a total. Understand the presentation, sir. Venture wise you have to present it. Don't write directly sales, direct sales I will write. No, venture wise sales, goods taken over venture wise, and now debit side of the consolidated P&L account, obviously expenses. Venture wise, what will be the expenses? What will be the expenses for A? What will be the expenses for B? So the joint venture expenses, which is shared between the ventures, right? So what will be A share? What will be B share? Then you'll get the profit. What will be the profit for venture A? What will be the profit for venture B? So consolidated P&L account is quite simple, sir. Credit side sales, goods taken over, debit side expenses, you will get a profit. So you will get an overall profit of the joint venture. And this profit, whatever earned, it will be shared between the ventures in agreed ratio, A and B. For example, equally they will agree. Agreed ratio is 1:1. So therefore, whatever the profit generated, sir, that will be shared equally between the parties. Equally between the parties. So this is consolidated P&L account. Now come to individual books of the venturers. As I already told you, in the individual books of the venturers, they are going to prepare a joint venture account in order to have control over joint venture activity. And this joint venture account is exact replica of consolidated P&L account, but individual venturer point of view. See, suppose if I am preparing in the books of A, in the joint venture account, generally what I present is, on the credit side I am going to present what will be the sales of A and goods taken over by A. Same which is there in the consolidated P&L account, credit side sales, goods taken over. And also debit side I will write what will be the expenses of A and also the profit of A. Sir, this profit already we got it now, sir. When we prepare consolidated P&L account, whatever the profit we got for the venture, we have shared in the agreed ratio between the parties now, sir. So adopt this profit from here. So this profit you write here. So in the joint venture account, credit side sales, goods taken over by the individual venture, debit side expenses incurred by the individual venture, profit of the venture shared by the individual venture. Now, whether this joint venture account automatically gets tallied, sir, the answer is no, it will not get tallied. Why? I'm going to explain it. Wait. And also come to the venture B. Suppose if you have second venture, same in the books of B, again we are going to prepare a joint venture account. In that joint venture account, we will write what will be the sales on account of B, goods taken over by B, and expenses of B, and what will be the profit of the B in the joint venture, which already arrived from consolidated P&L account. So from the consolidated P&L account, whatever the profit arrived, sir, that profit belongs to B, write it. Right? Now, whether this joint venture account will tally automatically? May not be. Why it may not be tally? I will tell you. For example, sir, ultimately we got a profit of 10 lakhs, sir. 10 lakhs. And they are sharing profits in equal ratio. For example, so A 5 lakhs, B 5 lakhs. Okay. A 5 lakhs, B 5 lakhs. Suppose sales, goods taken over, expenses. What happens is profits they are sharing, but is expenses also they have shared equally? Whether sales also generated equally? May not be. For example, A has done more sales, A has incurred more expenses, B incurred less expenses, but when it comes to profit, he is also taking equal profits. So what happens is sometimes the profits are shared equally, but expenses, sales may not generated in the equal same manner. So that's why this account will not tally. So that's why what we need to do when you are preparing joint venture account in the books of A, suppose there is a balancing figure. And this balancing figure is what? Nothing but amount to be received from the other party. Amount received from the other party. For example, here, A you take, suppose for example, sales he has done some amount, goods taken over some amount, expenses some amount, profit he got it. And suppose still there is a balancing figure. This balancing figure is nothing but by bank balancing figure, which is nothing but amount received from B. Amount received from B. And B point of view also, you see his account will not tally. So now the balancing figure is to bank balancing figure, that is amount paid to A. See, we are going to solve one question, sir. Through that question you will understand why this is coming, because it is like when it comes to efforts, when it comes to expenses, you are not bearing expenses equal to me, but when it comes to profits, you are taking equal profits. That is not fair now. So that's why whoever paid less expenses, he has to compensate to the other party. So that's why the balance figure is what? Suppose A point of view by bank, he is the amount receiving from B. So that means A will receive the amount from B. B will have to pay the amount to A. Maybe because B has paid less expenses, but he is taking equal profits. That's why. Or maybe B has done less sales, but when it comes to the profits, he is enjoying equal profits. That's the main reason, sir. Understand, sir? So we are discussing jointly controlled operations, sir. In jointly controlled operations, consolidated P&L account will prepare, and in the individual accounts of the ventures, we are going to prepare the joint ventures account in order to have control over joint venture transactions. Okay. Actually, we have one question relating to it. Let us try to solve that question. Now, illustration number 1 from Accounting Standard 27. So, see this. Mr. A, Mr. B and C entered into joint venture to purchase a land, construct and sell flats. Mr. A purchased a land for 60 lakhs on 1/1/2011, and for the purpose he took loan from a bank for 50 lakhs at 8% interest per annum. So ABC together they want to execute one project, joint venture. So they will purchase the land, construct and sell the flats. This is the operation. For this they join together. Here Mr. A will purchase the land, 60 lakhs worth of land he purchased, and 50 lakhs he has taken a loan with 8% interest per annum. He also paid registration fees 60,000 on the same day. So Mr. A point of view, he purchased the land by taking a loan and he paid the registration fees. Next, to come to Mr. B, he supplied the material for 4,50,000 from his godown, and further he purchased the materials for 5 lakhs for the joint venture. See, Mr. B point of view, if you think, sir, from his godown he utilized 4,50,000 worth of materials and he purchased additionally 5 lakhs worth of materials, so total 9,50,000. And come to Mr. C, met all other expenses of advertising, labor and other incidental expenses, which turn out to be 9 lakhs. So if you see carefully, each one they're using their own resources. Mr. A is purchasing the land, Mr. B is incurring material cost, Mr. C is incurring advertising cost. Next, on 30th June 2011, each of the venturer agreed to take away one flat, each to be valued at 10 lakhs each flat, and rest were sold by them as follows: Mr. A 40, Mr. B 20, Mr. C 10 lakhs. Loan was repaid on the same day by Mr. A along with interest, and net profits were shared by the partners equally. So actually this venture started on 1/1/2011, completed on 30th June 2011. Each venture has taken one flat and rest of them was sold. Loan was repaid on the same day by Mr. A, because he has taken the loan, he repaid the loan along with the interest. Net profits were shared by the partners equally. So whatever the net profits earned, they shared equally. See, this equal ratio, they have shared it. You are required to prepare the draft consolidated P&L account and joint venture account in the books of each venturer. So they're asking us to prepare the consolidated P&L account as well as joint venture account in the books of each venturer. So see, this is what jointly controlled operations, sir. So consolidated P&L account, I told you how to prepare: sales, goods taken by the venturers, expenses, profit. Then in the individual books of the venturers, we have to prepare the joint venture account. Okay. Now let us try to solve this question, sir. First, illustration number 1. First, consolidated P&L account we are going to prepare. Consolidated P&L account. In consolidated P&L, first credit side will write sales A, B, C on account of each venture. What will be the sales? Next, to buy goods taken over by A, B, C given in the question. Actually here, instead of goods we can say flats, because they're executing a project of construction, right? So flats taken over. And this side, coming to expenses, sir, Mr. A purchase what? Land. So to purchase of land and 2 registration fees, these are incurred by A. Coming to B, I think material cost. And coming to C, sir, advertising, labor cost, etc. This is C. Okay. Next, Mr. A also paid what? Interest on loan. Just you need to see the items, copy paste it. Everything. First you take the sales clearly given 40, 20, 10. 40, 20 lakhs, and then 10 lakhs. So total sales it will be 70 lakhs. Now coming to flats taken over, each one has taken over a flat of 10 lakhs. So 10, 10, 10. So total it was 30 lakhs. Right? Given in the question. Land they have purchased, sir, worth of 60 lakhs. Of course, loan is taken only for 50 lakhs. Registration fees, I think 60,000. Material cost 4 lakh 50 from his godown, and he further purchased materials 5 lakhs. So total 9 lakh 50,000 worth of materials. B side he incurred. Advertisement and labor cost come to 9 lakhs. And coming to interest, sir, I think they have taken a loan of 50 lakhs, sir, 8% interest, and 30th June they have repaid it. So therefore on 50 lakhs, 8% interest for 6 months if I calculate. So 50 lakhs, 8% interest for 6 months. So it will be 2 lakhs interest, which is paid by A. I think everything we have recorded, sir. Now finally we will get what? Profit this profit will be shared by ABC equally. They have given in the question, right? Profits they are sharing equally, but expenses, revenues, there is a difference. So that's why I told you in the individual accounts of the joint venturers, this joint venture account will not tally. The difference is nothing but the payments made between the venturers. Okay, we'll see. I logically explain you. Now, if I calculate the profit in this case, actually total 1 crore, sir. 1 crore is the total. Now, debit side, if you see, 60 lakhs plus 60,000 plus 9,50,000 plus 9 lakhs plus 2 lakhs. 81 lakh 10,000 minus 1 crore. So it will be 18 lakhs 19,000. 90,000 is the profit, sir. 18 lakhs 90,000 is the profit, which is shared by 3. That is 6 lakhs 30, 6 lakhs 30, 6 lakhs 30. So total it will be 18 lakhs 90,000. So each one will share a profit of 6 lakhs 30, 6 lakhs 30, 6 lakhs 30. Okay. Now see, actually interesting points I am going to tell you. Suppose first to see, C sir, C. Come to C. What is his sales? 10. Flats taken over another 10, 20. But look at what is the expenses bared by C. 9 lakhs. 9 lakhs. And what is the profit he has taken? 6 lakhs 30. Right? So therefore, if you see, his credit side is having 20 lakhs. His expenses will be 9 lakhs. So 11 lakhs will be the things, sir. Actually, C point of view. So there is a difference. And B point of view, if you see, 20 lakhs sales, 10 lakhs this one. So total 30 lakhs. And look at the expenses he bared, sir. See, B, 9 lakh 50. So it is 20 lakh 50,000. So the differences are coming, sir. So therefore, see this. Consolidated P&L over. Next, in the books of, look at carefully, in the books of A, joint venture account if I prepare. See this. If I prepare joint venture account in this case, by sales, what will be the sales of A, sir? A has done 40 lakh sales. See this, 40 lakh sales. And what will be the expenses he incurred, sir? He incurred expenses. If you see, purchase of land he has done by 60 lakhs worth of land he purchased, one thing. And also he incurred a registration fees of 60,000. And also, sir, he has paid interest worth of, interest value of 2 lakhs. And the profit finally he has taken is, profit taken is 6 lakhs 30. And also if you see carefully, flat taken over worth of 10 lakhs. So whether joint venture account tallied? No, it will not tally. Why? I will explain you. Wait. Now coming to in the books of B, joint venture account. Now same manner, whatever the items are there, please write it down. Like for example, sales. What will be the sales, sir? 20 lakhs. So what will be the flat taken over? 10 lakhs. And this side expenses, I think material cost he incurred. What will be the material worth of cost he incurred? 9 lakh 50. And there is a profit sharing of 6 lakhs 30. See, everybody is sharing equal profits here. But look at the sales they have done and the cost they have incurred. Look at A, for example. A has done a sales of 40 lakhs, sir. Expenses 60 plus 60 lakhs plus 60,000 plus 2 lakhs. And he has shaken only 6 lakhs 30. How it is justificable, sir? So that's why the difference is nothing but the payment made by one venture to another. The venturer who bear less expenses but equally has taken the profits. Like for example, you see the books of C, joint venture account. If I prepare, same thing. First sales. So what will be the sales? 10 lakhs. And what will be the flat taken over? 10 lakhs. So total 20. To this side, expenses, I think he has incurred advertising, labor, other cost, etc. And he incurred a cost of, I think, 9 lakhs. And how much profit he has taken, sir? Profit share, which is from consolidated P&L, 6 lakhs 30. Now look at him. He done a sales of 10 lakhs, but he has taken 6 lakhs 30. He bear expense of 9 lakhs. So if I close this account, see, so 20 lakhs is the total, sir. And 9 lakhs, the expenses he bear it. 6 lakhs 30 is the profit. So 4 lakhs 70,000 is the difference. This is nothing but what, sir? So this is the difference, sir, to bank balancing figure. This is amount paid to A. Amount paid to A. He has to make the payment to A. And similarly, if you look at B, the total is 30 lakhs. 30 lakhs is the total. Minus 9 lakh 50 minus 6 lakhs 30. So it will be 14 lakhs 20,000. What is this? This is bank. Amount paid to A. 14 lakh 20. So 14 lakh 20,000 plus 4 lakh 70,000. So it will be 18 lakhs 90,000, which is payable to, which is received by A. So by bank, balancing figure. So amount received. See, amount received from B, 14 lakhs 20. From C, 4 lakh 70. So total 18 lakh 90. So if you see 60 lakhs plus 60,000 plus 2 lakhs plus 6 lakhs 30. So total 68 lakhs 90,000 minus 50 lakhs. So 18 lakh 90 is the balance figure, which is nothing but amount paid by other parties. Correct? Logically you think, sir, logically you think, first come to C. You think, you see from C point of view, sales he has done only 10, flat taken over 10, total it is 20, but he paid expenses of 9 lakhs. His profit share is only 6 lakhs 30. So what will be the balance? 4 lakhs 70. That is nothing but amount paid to A. Why he has to make the payment to A? Because A is the person who make more sales and bears more expenses, but is taking equal profit. Right? So technically speaking, sir, B and C as making less sales and incurring less expenses. So they has to compensate to Mr. A, that is the venturer. So that's why. Hope you got it. So this is illustration number 1, sir. Next, we are going to discuss the accounting treatment for jointly controlled assets, which is another form of joint venture. See, in case of JCA, we are going to prepare the consolidated balance sheet. And in the individual books of the venturers, we are going to prepare P&L extract as well as balance sheet extract. So in the consolidated balance sheet, first we are going to show the assets. We have already discussed in case of JCA, there are common assets, joint assets, which is shared by all the venturers. So that we need to show. And equivalent to the assets, there will be a share capital, which is shared by the venturers. So share capital assets we are going to present in the consolidated balance sheet. And in the individual books of the venturers, we are going to show the P&L extract as well as the balance sheet extract. Okay, very simple accounting treatment. Now come to the jointly controlled entities. Jointly controlled operations, jointly controlled assets, jointly controlled entities. In jointly controlled entities, I told you a separate entity will be formed for joint venture. So in case of jointly controlled entity, there is a separate entity for joint venture. So what is the accounting treatment? Here we need to follow proportionate consolidation method. Sir, what is this proportionate consolidation method? Very simple, sir. In the joint venture, the venturer share in the revenues, expenses, assets and liabilities will be consolidated, right? So venturer share of assets, liabilities, revenues, expenses is reported as separate line items in the venturer's financial statements. So in the venturer's financial statement, suppose A, now A individual financial statements, in the joint venture, assets, liabilities, revenues, expenses, the share, his share will be added. This is called proportionate consolidation method. Of course, we have a question, we are going to solve it. Okay. So in case of JCO, jointly controlled operations, so parties are joining together to undertake a particular venture operation, right? So they use their own resources or assets, and assets and expenses, revenues will be shared in agreed ratio. So we are going to prepare consolidated P&L, as well as in the individual books of the venturers, we are going to prepare joint venture account. Next, JCA, there is a joint assets, so which they agree to construct and maintain this asset. Now in case of JCA, we are going to prepare the consolidated balance sheet, will show assets as well as the share capital. In the individual books of the venturers, balance sheet extract, P&L account extract, that means their share in the joint venture assets, expenses, we are going to show. Now in case of JCE, jointly controlled entity, new entity is formed for joint venture. So therefore here we are going to follow proportionate consolidation method. That means venturers share in the assets, liabilities, expenses, revenues of the joint venture will be proportionately added. Okay. And we are going to prepare the consolidated P&L account and consolidated financial statements by following this proportionate consolidation method. Okay. Now come to the next illustration number 2, sir. See this illustration. A Limited, B Limited, C Limited decided to jointly construct a pipeline to transport the gas from one place to another that was manufactured by them. See this? So three parties A, B, C joined together to construct a pipeline, okay, and then transport the gas from one place to another place. So here the main thing is what? The parties are joining together to construct and maintain an asset, and thereby they want to earn some revenue. For the purpose, the following expenditure was incurred by them: building 12 lakhs to be depreciated at 5% per annum, pipeline 60 lakhs to be depreciated at 15%, computers and other electronics for 3 lakhs to be depreciated at 40% per annum, and various vehicles 9 lakhs to be depreciated at 20% per annum. They also decided to equally bear the total expenditure incurred on maintenance of the pipeline, that comes to 6 lakhs. See this, there is a joint assets. See, these are all joint assets, right? Now relating to these joint assets, whatever the maintenance expenditure is there, 6 lakhs each year, that they decided to share equally. See this, the total expenditure incurred on maintenance of the plan, they decided to bear equally. So therefore this 6 lakhs will be shared 2 lakhs, 2 lakhs, 2 lakhs, like that, everybody. Now what they're asking here, you are required to show the consolidated balance sheet and extract of P&L and balance sheet of each ventures. Now you tell me here, what is this? Is this JCO or JCA? The JCA clearly visible. So here parties are joining together to construct and maintain an asset. And there is a joint asset which everybody have their own share in these assets, right? And also whatever the cost they are incurring to maintain this pipeline, they decided to share equally. Now in this case, what they are asking, consolidated balance sheet first, and then statement of P&L account for each ventures they are asking. So therefore first, when you prepare consolidated balance sheet, you are going to show buildings 12 lakhs, depreciation minus pipeline, depreciation 15%, computers and other electronics minus depreciation, vehicles minus depreciation, and equivalent to that there is a share capital equally, A limited, B limited, C limited. Very simple. So 12, see this, suppose if they prepare consolidated balance sheet, asset side, non-current assets, property, plant, equipment. You see, property, plant, equipment, first land and buildings. What is the total land and buildings value? 12 lakhs, 5% depreciation. So 12 lakhs, 5% depreciation. So 60,000 is the depreciation per annum. So 12 lakhs minus 60,000. 11 lakh 40,000 divided by 3. So 3 lakh 80,000. See this, A 3 lakh 80, B 3 lakh 80, C 3 lakh 80, 11 lakh 40. Land and building over. Next, plant and machinery. What will be the plant and machinery value? Plant and machinery is, pipeline, nothing but 60 lakhs, which is depreciated for 15%. So it is 51 lakhs after depreciation. Divided by 3. Each one 17 lakhs. Next, computers and other electronic items, 3 lakhs, 40% depreciation. So it will be 1 lakh 80,000. Divided by 3. So 60, 60, 60. And then come to vehicles, 9 lakhs, which is to be depreciated at 20% per annum. That is 7 lakh 20 divided by 3. So 2 lakh 40, 2 lakh 40, 2 lakh 40. 7 lakh 20. Very simple. So total it is how much? Total assets, if I add 11 lakh 40, 51 lakhs, 1 lakh 80 plus 7 lakh 20. So total it is 71 lakh 40,000. Note number 2. Now equivalent to this 7 lakh 40 divided by 3, 23 lakh 80,000 share capital for each venture. Because this is the share in the assets. Now to that extent their share, I am considering this as a share capital, they contribute to the joint venture. So equity and liability, shareholders fund, share capital, note 1, 71 lakh 40. So for venture point of view, total contribution 71 lakh 40, and for joint venture the assets are 71 lakh 40,000. This is how we need to present. And also when you look at the individual books, suppose A limited you take, we need to prepare the extract of P&L as well as balance sheet. Now first, if you take P&L account, generally what will show P&L account, we are going to show depreciation and amortization expenses. For example, depreciation of each asset, if you take, for example, buildings 12 lakhs into 5%, 60,000. Pipeline 60 lakhs into 15%. Computers 3 lakhs into 40%. Vehicles 9 lakhs into 20%. So total 12 lakh 60,000 divided by 3. So 4 lakh 20,000 is the depreciation for each one. A limited P&L account extract depreciation and amortization 4 lakh 20. Okay. Now see this. How we got this 4,20,000? Each asset their share. Suppose land and building total depreciation 60,000. 60,000 divided by 3. Plant and machinery total depreciation divided by 3. Computers total depreciation divided by 3. Vehicles total depreciation divided by 3. Like that. Okay. And also one important thing, sir, in P&L account, other expenses, other operating expenses, we are going to show their share in the maintenance cost. Actually, the total maintenance cost is 6 lakhs each year, right? 6 lakhs divided by 3. So each joint venturer has to bear 2 lakhs. This is the extract. So I think, and also now coming to the balance sheet extract, sir. In the balance sheet asset side, non-current assets, property, plant, equipment, we are going to show. Each one property, plant, each venturer's share in the property, plant, equipment, very simple. So for example, you take land and buildings. Total land and buildings 12 lakhs. In that, divide by 3 if I do, 4 lakhs. Depreciation 60,000, divide by 3, 20,000. Plant and machinery total 60 lakhs. Their share 20 lakhs. Total depreciation 9 lakhs, I think. 60 lakhs into 15%. 9 lakhs divided by 3, 3 lakhs. Like that. Computers total 3 lakhs. Each venturer share 1 lakh. Depreciation 1 lakh 20. Each venturer share 40,000. Vehicles total 9 lakhs. Each total depreciation, I think 1 lakh 80. So simple, sir. Each venturer share you write down, sir. Like that you have to write. So in the extract of the P&L account, we need to show depreciation and amortization expenses as well as other operating expenses. And in the balance sheet, their share in the assets. Similarly, B, depreciation and amortization, operating expenses. Same presentation again. C also see depreciation and amortization, other operating expenses. Asset side 23 lakh 80. Same thing. Very simple. Okay. So this is illustration number 2, sir. Jointly controlled assets. Now see illustration number 3, sir. A Limited, a UK based company, entered into joint venture with B Limited in India, wherein B Limited will import the goods manufactured by A Limited on account of joint venture and sell them in India. A Limited and B Limited to share the expenses and revenues in the ratio of 5:4 respectively, whereas profits are distributed equally. See this, revenues and expenses are shared in 5:4 ratio, profits are distributed equally. A Limited invested 49% of the total capital but has equal share in all the assets. See this, A Limited contributed 49%, but they get equal share in all assets and is equally liable for all liabilities of the joint venture. Okay. Following is the trial balance of the joint venture at the end of the first year. So see the facts of the question. First thing is, there are two entities, A Limited and B Limited, sir. Both have started a venture. What is that? A Limited is UK based company. They have entered a joint venture agreement with B Limited in India, where B Limited will import the goods manufactured by A Limited. A Limited is the manufacturer. They will manufacture the goods. B Limited will import it and sell it in India, right? So they have entered a joint venture for this. Now, what is the agreement between them? The agreement is to they agree to share the expenses and revenues in 5:4 respective. So revenues, expenses 5:4 ratio. Whereas profits are distributed equally. Profits must be distributed equally. And A Limited invested 49% of the capital but has equal share in all the assets, equally liable for all liabilities of the joint venture. Following is the trial balance of the joint venture at the end of the year. Purchases. So purchases comes under expenses. So which ratio? 5:4 ratio. So if I share 5:4 ratio, 5 lakhs, 4 lakhs. Other expenses 3 lakh 6,000 divided by 9 into 5. 1 lakh 70. 5:4 ratio. Sales, revenues 5:4 ratio. 7,25,000. Property, plant, equipment, assets. Assets are shared equally. So 3 lakhs, 3 lakhs. So this is 5:4, 5:4. This is 1:1. Current assets also 1:1. 1 lakh, 1 lakh. Unsecured loans, liabilities also 1:1 ratio. 1 lakh, 1 lakh. Current liabilities 1:1 ratio, 50k, 50k. Capital, of course, equal ratio generally. A capital, see, the A Limited invested 49% of the total cap. $1,96,490. Balance 2,04,510 B. So what they're asking, closing inventory was 1 lakh. Closing inventory given 1 lakh. You are required to prepare consolidated financial statements. That means consolidated balance sheet as well as consolidated P&L we need to prepare. Now suppose if I prepare first a consolidated P&L account, generally in consolidated P&L account what we are going to show, revenue from operations, other income total, then expenses side we are going to show change in inventories of the purchase of stock in trade, change in inventories of the finished goods, work in progress, finance cost, depreciation, and employee benefit expenses, other expenses, these things we will show. So here first we are going to show revenue from operations. What is the revenue from operations here? Revenue from operations is nothing but this one, sales 13,05,000 will show. Other income we don't have. Next expenses side, purchases will show, and other expenses we will show. And also we have inventory, closing inventory 1 lakh, opening inventory is nothing, so change in inventories we will show. So these are the items which comes in the consolidated P&L account. When it comes to balance sheet, assets, non-current assets, first equity and liabilities, shareholders funds, share capital we will show, reserves surplus nothing is there, non-current liabilities, unsecured loans, current liabilities, current liabilities are there. Now asset side, non-current assets, property, plant, equipment, then current assets. That's it, very simple, just presentation. But when you're presenting notes to accounts, you need to share, sir, A Limited how much, B Limited how much, A Limited how much, B Limited how much, in the ratio which they agreed now, that ratio we need to show. Now see the first consolidated P&L accounts are first. Particulars, note number rupees. First revenue from operations, note number 1. Revenue from operation is nothing but what? Sales, 13,05,000. But if you see the breakup of note number 1, see sales, how they agreed 5:4 ratio. So 7,25,000, 5,80,000. See this, I have written here already. 7,25,000, 5,80,000. In this ratio we need to show. Next, total revenue. Then expenses, first we need to show purchases 9 lakhs, 5 lakhs, 4 lakhs. So 9 lakhs. Note number 2. If you see note number 2, they have presented purchases AB 5:4 ratio. Next, change in other expenses also there. Change in inventories of finished goods. Change in inventories of finished goods is nothing but the difference between opening and closing stock. Here opening stock is nil, closing stock is 1 lakh. So 0 minus 1 lakh. So minus 1 lakh. Other expenses 3,06,000 given. So therefore, if you prepare a note to other expenses, A Limited, B Limited, 5:4 ratio. Closing inventory also, change in inventories, we need to share it in assets, current asset, right? So 50-50, equally. Assets and liabilities equally, sir. Expenses, revenues, 5:4 ratio. Okay. Total expenses. So revenues minus expenses, profit before tax. So this is consolidated P&L. Now come to balance sheet. Equity and liability, shareholders funds, share capital, Note number 5. So what is note number 5? Share capital, how much? 4 lakhs 1000. So 4 lakh 1000, how the breakup they have given? See this. A limited 49%, B limited 51%. This total 4 lakh 1000. 49% is 1 lakh 96,490. Okay. Now coming to reserves and surplus, sir. Actually, they don't have reserves and surplus, but during there they have earned a profit of 1,99,000. That will come in reserves and surplus. So 1,99,000. Profits are shared equally. 1,99,000. Next, non-current liabilities, we have long-term borrowings, that is unsecured loan, note number 7. Unsecured loans 2 lakhs shared equally. Next, current liabilities 1 lakh shared equally. Total. Now coming to assets, non-current assets, we have property, plant, equipment, note number 9. So share between A limited and B limited. Inventory is also 1 lakh. Other current assets 2 lakhs equally. So assets and liabilities are equal, sir. Present them. Current assets, inventories, other current assets. Very simple now. See, because in the question itself they have clearly mentioned. You just need to segregate in the consolidated P&L as well as the consolidated balance sheet. So this is illustration number 3, sir. Now see illustration number 4, sir. A limited entered into joint venture with B limited on 1:1 basis. 1:1 basis. And a new company C limited was formed for the same purpose, and the following is the balance sheet of all three companies. See here, A, B entered into joint venture and they form a new company C limited. So this is what jointly controlled enterprise. And I told you in case of JCE, we need to prepare consolidated financial statements by following proportionate consolidation method, right? See this. So they have given A limited balance sheet, B limited balance sheet, joint venture C limited balance sheet. Share capital, reserves and surplus, loans, current liabilities, property, plant, equipment, investment in joint venture, A limited investment, B limited investment, equal investments, current assets. What they're asking, sir, prepare balance sheet of A limited and B limited under proportionate consolidation method. Proportionate consolidation method means very simple. In expenses, revenues, assets, liabilities, what is your share as a venture? You just add to your items. That's it. Consolidation is over. So if I start preparing here the consolidated balance sheet, suppose illustration number 4, balance sheet of A limited. So first we will start with part 1, equity and liabilities, note, and then amount. First, shareholders funds, in that share capital. Second, reserves and surplus. So share capital, when it comes to share capital, when you are preparing the balance sheet of A limited, you take A limited share capital. Don't take share capital proportion of joint venture here. Your investment we will not consider, this 2,50,000. Actually in this 5 lakhs your investment is 2.5, that we will not take. In the place of investment in joint venture, we are going to consider the assets, liabilities, our share. So 10 lakhs share capital we will write. When it comes to reserves and surplus, so note number 1, we are going to prepare. And then when it comes to liabilities, non-current liabilities, we have loans. Non-current liabilities, in that long-term borrowings, note number 2. Any other liabilities long-term? No. Next we have current liabilities. Current liabilities, note number 3. And then total. Now coming to asset side, first we have non-current assets. In the non-current assets, PP, property, plant, equipment, note number 4 we had, and then current assets we had, note number 5, and then total. Okay, so let us try to prepare notes to accounts, sir. The first one, share capital, not share capital, share capital directly we have written, reserves and surplus. Now when it comes to reserves and surplus, you are preparing the balance sheet of A. So A Limited reserves and surplus balance is how much? 18 lakhs. Consider that. And also in C Limited, that is joint venture, what is your share? Equal share. 1:1 basis, right? So in this, the reserves and surplus of joint venture is 12 lakhs. In this, our share is 6 lakhs. A Limited share. So total it is 24 lakhs. So reserves and surplus 24 lakhs. This you present here. Next come to non-current liabilities, long-term borrowings. In long-term borrowings, we will show loans. In that loan, A Limited loans is 3 lakhs. And in the C Limited, 2 lakhs. In that our share 1 lakh. Proportionate. So 4 lakhs you take it. So 4 lakhs I am going to show here. Now comes to current liabilities, note 3. So when it comes to current liabilities, 4 lakhs A Limited. And C Limited, in joint venture, what is our share? Total 1 lakh, in that 50%, 50,000. So total it is 4 lakh 50,000. So very simple, proportionate consolidation. So 10 lakhs, 24 lakhs, 4 lakhs, 4 lakh 50. So total it is 42 lakhs 50,000. So 42 lakhs 50,000, sir. Now come to asset side, sir. PP first. Property, plant, equipment. A Limited property, plant, equipment 30 lakhs 50,000. And what will be the share of A Limited in joint venture? Total 19 lakh 50. So 9 lakh 75,000. So total it will be 30 lakhs 50,000 plus 9 lakh 75. Total it is 40 lakhs 25,000. 40 lakhs 25,000. 40 lakhs 25,000. Next come to current assets. In current assets you see 2 lakhs A Limited share. And in C Limited, what is the share of A? Total 50,000. On that 50%, I mean half, 25,000. So 2,25,000. So it will be 42,50,000. That's it. So very simple proportionate consolidation method. So if at all they have given this type of questions in examination, so very simple, you can easily solve the balance sheet. You just take your share in the joint venture and add to your items. Like for example, see this balance sheet, equity and liability, shareholders fund, share capital, A limited. Don't take joint ventures, your investment share. Reserves and surplus, note 124. How they are presenting reserves and surplus? What is your reserves and surplus? A limited. What will be your share in the joint venture reserves and surplus? 6 lakhs. So similarly, non-current liabilities, long-term borrowings, loans, A limited 3 lakhs. In C limited, what will be the loans? In that 2 lakhs. In that our share 1 lakh, like that. Like similarly current liabilities, assets also. Okay. Now same thing we need to do for balance sheet of B limited also. So when you prepare the balance sheet of B limited figures plus B limited share in the assets liabilities of A limited. Sorry, B limited figures plus assets and liabilities of joint venture. In that B limited share you just add. You'll get the reserves and surplus. So when you're preparing here, you will not consider what investment in joint venture, you will not consider. Instead of investment in joint venture, you will consider the joint venture, your share in the assets, liabilities, reserves. Okay, that's it. This is proportionate consolidation method, sir. Proportionate consolidation method. So this is question number 4. Now see, test your knowledge questions, sir. Multiple choice questions. State which of the following statements are incorrect. Incorrect statement they're asking, sir. The requirements relating to accounting for joint venture and consolidated financial statements according to the proportionate consolidation method as contained in AS 27 applies only when consolidated financial statements are prepared by venture. Yes, correct. This is correct statement, sir. The requirements relating to accounting for joint ventures in consolidated financial statements according to proportionate consolidation method as contained in AS 27 applies irrespective whether consolidated financial statements are prepared by venture or no. See, this applies only when we prepare consolidated financial statements. An investor in joint venture which does not have joint control should report its interest in joint venture in consolidated financial statements in accounts is 13. Correct. This point I told you. When I'm discussing the definitions, I told you who is what is joint venture. There should be a joint control, but there are some investors in the joint venture we does not have joint control. Then they will be treated as investors, and accordingly accounting will be done as per AS 13. So this is also correct. I think point 2 is incorrect, sir. So the answer is B, I think. So first bit B, correct. Now see the second question. Identify which of the following is not a feature of jointly controlled operations. Okay. Each venturer has his own separate business. Yes, it has. Correct. Right. Next, there is a separate entity for joint venture business. No, there should not be any separate entity, sir. In JCO and JCA, there are no separate entities. Each venturers record only his own transactions without any, yes, they will record their own, right? There is a common agreement. Yes, correct. So I think except B, everything is right. So B is the second bit answer. Correct. Yes, which is not a feature of JCO. Now come to third. Identify which of the following is not a feature of jointly controlled asset, which is not a feature. There is a separate legal entity. Wrong. There is no separate legal entity in case of JCA. And there is a common control. Yes. Expenses on jointly held assets are shared. Yes. In their financial statement, venturer shows only their share of assets and total income. Yes. I think this one, sir. Point number 1 only incorrect, which is not a future actually. Third, yes. Now coming to fourth, identify which is our futures of jointly controlled entities. Okay, venture creates new entity for their joint venture business. I think this is correct. No new entity will be formed in case of JCE. Next, all venturers pool their resources under new banner, and this entity purchase its own assets, create its own liabilities, expenses are incurred by the entity. I think this is also correct. The revenues and expenses of the entity shared by the ventures in their equal ratio. No. In case of JCE, there is no equal share, proportionate share. Equal ratio only. No, not correct. So I think which are the futures means, I think 1 and 2. I think B is the correct answer, sir. Fourth one, B. Yes. Now come to last one, identify the correct statement. From the date of discontinuing the use of the proportionate consolidation method, if interest is more than 50%, investment in such joint venture should be accounted in accordance with AS 21. No. Which of the identify the correct statement? If interest is 20% or more, up to 50, investments are accounted for in accordance with AS 23, accounting for investment in associates. Correct? 20 to 50%, I told you AS 23 will be followed. For all other investments in joint ventures is treated as AS 13. No. For this purpose, the fair value of the investment on the date on which joint venture relationships is to exist should be regarded as cost. No. I think the correct statement is only second one, sir. 1 minute. Which is asking correct statement they're asking. Okay. I think fifth B bit they're asking, sir. Okay. Point number 1, 2, 3. I think 1 minute. I have taken some wrong assumptions here. See, they're asking correct statements. Okay. I thought which is incorrect. Okay. If interest in entities more than 50%, the investment in such joint ventures should be accounted for in accordance with AS 21 consolidated financial statements. Okay. And also second, okay, P. For all other investments in joint venture, yes, this is correct. I thought correct. Now this is wrong. So remaining and all correct only. 1, 2, 3. P, the correct answer. Okay. Next, there is one scenario based question, sir. JVR Limited has made investments of 97.84 crores in equity shares of QSR Limited in pursuant to joint venture agreement till 11/12, more than 12 months. The investment has been made at par. QSR Limited has been in continuous losses for the last 2 years. JVR Limited is willing to reassess the carrying amount of its investment in QSR Limited and wish to provide for diminution in the value of investments. However, QSR Limited has a futuristic and profitable business plans and projection for the coming years. Discuss whether the contention of JVR Limited to bring down the carrying amount of investment in QSR Limited is in accordance with accounting standard. First of all, sir, here understand, sir, there is a company JVR Limited. They have made investment of 97.85 crores in the equity shares of QSR Limited. So in the JVR Limited books, there is an investment in QSR Limited 97.84 crores in pursuance of this joint venture agreement. But the problem is investments are made at par only. Okay. But this QSR Limited, the company where we invested, continuous losses there for the last 2 years. So since the company where we invested is suffering losses, JVR Limited is willing to reassess the carrying amount of its investments in QSR Limited and wish to provide for diminution in the value of investments. Now, I think if you read Accounting Standard 27, okay, it says in respect of this, as per AS 27, financial reporting of interest in joint ventures, in venture separate financial statements, interest in jointly controlled entity should be accounted for an investment in accordance with AS 13. If you recollect AS 13, sir, which says investments are generally carried at long-term investments generally carried at cost. Of course, if there is a decline due to reasons other than temporary, then we need to brought the investments from their cost to. the market value. Now here, investments are made for more than 12 months. So definitely they are long term. Now whether these long term investments should be carried at, which will be shown at cost only, carrying value only, or should it be brought down to its market value? We need to see what is the reasons for decline. Is the reason is temporary or other than temporary? If the reason is temporary, we will ignore. If the reasons are other than temporary, then we will brought the investment to its market value. See, in the question they have clearly given QSR Limited, that means the company where we are, is futuristic and profitable business plans and projection for the coming years. The QSR Limited is thinking that they're very positive, they're futuristic, and they have some profitable business plans. They're projecting profits for the coming years. So therefore, you can take a call here that if the reasons for a decline is temporary other than temporary, if you assume it is temporary, then ignore it. If you assume it is not temporary, then you brought the investment to its market value. Actually, that is what they have given. So considering both the facts, since investments was made in 11-12, more than a year, it is a long-term investment. In the given case, though QSR Limited is continuous losses for past 2 years, yet it has futuristic and profitable business plans and projections for the coming years. Hence, here one of the indicators, loss incurred to the companies, may lead to diminution in the value of shares, while the other indicators that company has positive expected cash flows from the business plan does not lead to decline in the value of shares. Considering both the facts, in case the expectation of profitable business plans and positive cash flows is based reliable presumption such as tender in favor of QSR Limited, strong order book, the decline will be regarded as temporary in nature and the investment in equity shares is continued to be carried at cost only. However, should the aforesaid presumptions be based on projections without reasonable evidence backing the claims, the decline should be regarded as non-temporary in nature, and in which case the write down of the carrying amount become necessary in line with AS 13, thereby implying the contention of QSR Limited to be correct. So therefore, you have to write both the answers. If the presumption goes well as company expected, these are reliable estimations, company definitely will recover. It is temporary, ignore it. No sir, these presumptions are doubtful, whether company is going to earn profits or not, there is a doubt. So then in such situation, ignore it. And the reason is other than temporary. Therefore, you need to write down the inventories from their cost to the market value. Okay, that's it, sir. So these are the questions. Question number 1 from supplementary material in consolidation chapter, sir. This question, January 2025 attempt exam question, 14 marks. Very simple question they have asked, sir. Consolidated balance sheet. No much adjustments. See the facts. There are two entities, Super Limited, Clear Limited. Their balance sheets given on 31st March 2024. Equity and liability, shareholders fund, share capital, reserves and surplus. Non-current liabilities, we have long-term borrowings. Current liabilities, short-term borrowings, trade payables. Asset side, non-current assets, property, plant, equipment, non-current investments. Current assets, inventories, trade receivables, cash and cash equivalents. You see the notes to account, share capital, 8 lakhs equity shares of 10 each fully paid. 5 lakhs equity shares of 10 each fully paid. 15,000 preference shares of 100 each fully paid. So Super Limited is having equity as well as preference shares, but Clear Limited is having only equity shares. Reserves and surplus, general reserve, P&L account. Long-term borrowings, we have debentures, property, plant, equipment, land and building, plant and machinery, furniture and fittings. Non-current investments, investments in Clear Limited. Super Limited holds 75% equity shares in Clear Limited, sir, since the incorporation of Clear Limited. So from the beginning itself, 75% of the shares of the Clear Limited is held by Super Limited. So Super Limited is what, sir? Holding company. Clear Limited is subsidiary company. So AS 21 we need to apply for preparation of consolidated balance sheet. 25% of the trade receivables of Super Limited is due from Clear Limited. Super Limited trade receivables, 5,85,000. On that 25%. 146,250 is due from Clear Limited, sir. So intercompany borrowings we will eliminate. During the year, Super Limited sold inventory costing 2 lakhs to Clear Limited at a price of 15% above the cost. So parent company sold goods to subsidiary company. So it's a downstream transaction. So we need to eliminate unrealized profit from the consolidated reserves of the parent company in step number 8. And also from the stock, we need to eliminate the unrealized profit. The cost of the goods given 2 lakhs, sir. The profit is 15% above the cost. So 2 lakhs into 15%. It will be 30,000, sir. Unrealized profit. You are required to prepare consolidated balance sheet. So January 2025 question. Is 21. First, date of acquisition. Date of acquisition, you know, since incorporation, sir. Next, shareholding pattern. 75% held by Super Limited. Remaining 25% held by minority interest. Next, analysis of profits of subsidiary company. All profits are what? The post acquisition profits, because since incorporation the holding is there. So whatever the profits earned by the subsidiary company since incorporation, they are all post only. So the question of pre-post will not arise here. All profits are post only. So look at the reserves and surplus first. General reserve is there. General reserve 6,50,000. So entirely this is post acquisition profit, which is nothing but revenue reserve. Now coming to P&L account, sir. 5,75,000 is there. 5,75,000. This is also post acquisition profits entirely, which is a revenue profit. Okay. Sir, any other adjustments? No, because no revaluation, nothing. Only thing is that unrealized profit is there, downstream transaction. This unrealized profit we will eliminate from the parent company reserves, consolidated reserves. And then once analysis is over, next apportionment. So there is no capital profits here. Entire profits are post acquisition profits, revenue profits, revenue reserves. So we have general reserve, which is a revenue reserve, 6,50,000. And we have P&L account, which is a revenue profit, 5,75,000. Okay, so no capital profit. So this is 5,75,000. This is 6,50,000. Now if I apportion this, Super Limited 75%, minority interest 25%. So 575 into 75%, 431,250, 143,750. 6,50,000 into 75%, 487,500, 162,500. So I think this is the analysis of profit, sir. You see the answer of this question. They have done the analysis. See this analysis. Parent company 487,500, 487,500, which is a revenue reserve. Revenue profit 431,250. We got it rightly. Minority interest, you see, 143,750. Revenue profit, we got it. Revenue reserve 160 to 500. The analysis we have done correctly. Analysis and apportionment we have done correctly, sir. And next step number 5, minority interest. Minority shareholders share in the net assets of the subsidiary 25%. So first, share capital of the company, subsidiary company. What is the share capital? For 50 lakhs, sir. On this 50 lakhs, 25%, which is 12,50,000. And also minority shareholders share in the post acquisition profits. Post acquisition profits, which is nothing but revenue profits and revenue reserve. What is the share? Go to step number 4, you will get it. 143,750 and 162,500. So you will get minority interest 12,50,000 plus 143,750 plus 162,500. So 15,56,250. 15,56,250 is the minority interest, sir. I think we got it correctly. Yeah, see this. 15,56,250 minority interest, we got it. Now once this is over, cost of control steps, sir. What is the cost of investment, sir? Super Limited, how much they have invested for 75%? See this, 41,50,000 less parent company share in the net assets of the subsidiary on the date of acquisition. Share capital of the subsidiary company total 50 lakhs. In this 50 lakhs, 75%. 37,50,000. And also there is no pre-acquisition profits. That's it. So 41,50,000 minus 37,50,000. So it will be 4 lakhs, sir. What is this 4 lakhs? I think this is goodwill. Goodwill, sir. So we got cost of control step, goodwill. Yeah, say this. Goodwill, we got it. Step number 7, intercompany owings are there. Sale is there. Downstream transaction happens, sir. So unrealized profit, 2 lakhs cost of the goods they sold. 15% is the profit. So 2 lakhs into 15%, which is 30,000, sir, unrealized profit. So this unrealized profit we need to eliminate. In step number 8, when you calculate consolidated reserves for consolidated balance sheet, so we need to consider the parent company reserves first. Say this, the parent company reserves are general reserve, P&L account. General reserve 15,50,000. P&L account 10,25,000. Now to this we need to add what is the share in the post acquisition profits. Parent company share in the post acquisition profits, which you will get by step number 4. So go to step number 4. See what is the parent company share in the post acquisition profits. 487,500, 431, 250. 487,500, 487,500 and P&L 431, 250. And also parent company sold goods to subsidiary. So there is an unrealized profit which we need to eliminate. How much? 30,000 from the parent company profits. So therefore 15,50,000 plus 487,500. So it will be 20,37,500. And this one 10,25,000 plus 431,250 minus 30. So it will be 1426 250. 1426 250. So reserves for consolidated balance sheet, we got it, sir. So general reserve 20 lakh 37,500. Correct. See this. P&L account 1426 250. Got it. That's it. I think when now you need to prepare the consolidated balance sheet. When it comes to share capital, consider only the parent company share capital. So note number 1, if you see, parent company equity share capital as well as preference share capital, both we need to consider. When it comes to reserves and surplus, we have done step number 8. Their general reserve to 20 lakh 37,500, we got it. P&L account 1426 250, we got it. And also capital reserve we got. Not capital reserve, cost of control, we got goodwill. That's it. These are reserves and surplus. Next, minority interest, we got it. Non-current liabilities, long-term borrowings, add both the companies. Current liabilities, short-term borrowings, add. Trade payables, add. Remaining items very easy. Non-current assets, property, plant, equipment, add both the companies. Write goodwill because cost of control we got goodwill of 4 lakhs. Current assets, inventory, parent, subsidiary minus unrealized profit, because the inventory which is sold by parent to subsidiary, that inventory unsold, in that inventory there is unrealized profit, that we need to eliminate. Trade receivables, add both the companies. Cash and cash equivalents, that's it. So both the companies, remaining items and all you need to just add. And also one more thing, sir, in the question I forgot to tell you that there is a mutual owings are there. 25% of the trade receivables of Super Limited is due from Clear Limited. So trade receivables of Super Limited, trade payables of Clear Limited, from both the things we need to reduce this intercompany owings. See this, from trade payables, mutual owings, from trade receivables also, you see mutual owings we have eliminated. That's it, sir. So this is how the question will be solved. Compared to the questions we have solved in the classroom, this question is very simple, sir. See, examination questions, sir, they are not testing too much, sir. Very simple only. So first you need to solve all the study material questions. You need to listen to the classes first carefully. After that you try to solve the examination questions. Automatically you can able to solve it, sir. Don't directly come and try to solve the supplementary material, sir. You won't get confidence. Okay, first complete the classes and then solve the study material questions, whatever the questions we have solved in the classroom, then come to the supplementary material and solve all of these things. Okay, this is January 2025 examination question. Now from consolidation chapter, sir, question number 2 from supplementary material. This question is a previous exam question, sir. September 2024 attempt question. See, the main thing in this question is they have not asked prepare consolidated balance sheet or consolidated P&L account, but they have asked small steps which involved in the preparation of consolidated balance sheet as well as consolidated P&L account. Now let us see the facts of the question, sir. See, there is a company Best Limited, sir, which acquired 80% equity shares of Cool Limited for 14,80,000 on 1st February 2024. On 1st February 2024, Best Limited acquired 80% equity shares of Cool Limited for 14,80,000. So obviously Best Limited is what? Holding company or parent company. Cool Limited will be subsidiary company because here 80% controlling interest acquired. Date of acquisition 1st February 2024. Next, on 31st March 2024, Best Limited also acquired 25% equity shares of Good Limited for 3,80,000. See this. On 31st March 2024, at the end of the year, Best Limited also acquired 25% equity shares of Good Limited. So 25% acquisition means no controlling interest, but significant influence. So it will be our associate, right? So Good Limited will be our associate, sir. Okay. Now if you apply consolidation here, for consolidation of subsidiary, we will apply AS 21. For consolidation of associate, we will apply AS 23. Now they have given the extracts of the items of the Best Limited, Cool Limited, Good Limited. So these are the details they have given: equity shares, so securities premium, debentures, general reserve, P&L account, investments, property, plant equipment, current assets, trade payables, sales and other income, raw material consumption, wages and salaries, production expenses. Look at the additional information. The P&L account of Cool Limited showed a credit balance of 30,000 on 1st April 2023. So Cool Limited is a subsidiary company, right? So subsidiary company opening P&L account balance is 30,000. The general reserve balance is brought forward from the previous year. So whatever the general reserve balance is there in the subsidiary company, it is brought forward from the previous year. So entirely opening balance only. Next, on 31st March 2024, all the bills payable in Cool Limited balance sheet were accepted in favor of Best Limited. However, on the date, Best Limited held only 3 lakhs of these acceptances in hand, the rest having been endorsed in favor of the creditors. Sir, intercompany borrowings, sir. Cool Limited books, there is bills payable. These bills payables were accepted in favor of what? Best Limited. So Best Limited point of view, bills receivable, parent company point of view, subsidiary company point of view, bills payable, both will be eliminated. You know this, intercompany borrowings. Next, Best Limited purchased goods costing 5 lakhs from Cool Limited on 1st June 2023 at a price of 6 lakhs 50. The entire goods remain unsold with the Best Limited at the end of the financial year. Sir, here Cool Limited sold goods to Best Limited before acquisition. 1st February 2024 is the date of acquisition. Actually, on 1st June 2023, what happened is this Cool Limited has sold goods to Best, or Best Limited purchased goods from Cool Limited. Now that means subsidiary company sold goods to parent company. So it's what? It is a upstream transaction. In case of upstream transaction, the who recognized the profit? The seller. Who is the seller here? Subsidiary company. How much is the profit they are recognizing? The cost is 5 lakhs, but they sold at 6 lakhs 50. So 1 lakh 50,000 is the profit. And is that profit is realized? No, because entire stock is remains unsold with the Best Limited. So therefore, I told you at the time of consolidation, if any intercompany transactions happened, especially purchase and sale, and if the profit is not yet realized, since they are not sold to outsiders, so the entire profit which is unrealized has to be eliminated. But here the subsidiary company books, the profit is there, and we analyzed and apportioned this profit between the parent and minority interest. So from minority interest calculation we will reduce, as well as in the parent company reserves, consolidated reserves, we will reduce. If you recollect what we have discussed in the class, that is very important. Sir, please don't solve these supplementary questions directly without having any previous knowledge, without listening to the classroom questions. Please go there, see the concept ones, see the solve all the questions from the classroom discussion, classroom whatever we have solved everything. After that you come to the supplementary material, then it will be very easy for you. Okay, next, Best Limited is preparing consolidated financial statements for the year ending 31st March 2024, because it's a parent company, it has to prepare consolidated financial statements. So what they're asking, you are required to calculate trade payables consolidated, current assets consolidated, minority interest, goodwill or capital reserve on acquisition of Cool's Limited shares, that is cost of control step in AS21, goodwill or capital reserve on acquisition of Good Limited shares, associate company. When you acquire associate company also, we need to calculate this goodwill or capital reserve. P&L account consolidated, general reserve consolidated, revenue from operations consolidated, cost of materials purchased or consumed consolidated. Okay, so you know, if you recollect what we have discussed, so this is September 2024 question from consolidation, sir. September 2024 AS21 consolidation question. Okay, first step is always what's the date of acquisition. See here, date of acquisition is 1st February 2024, correct? Next, sir, shareholding pattern on the date of consolidation. Date of consolidation is 31st March 2024. On the date of consolidation, who is having how much shares, sir? In the Cool Limited, Best Limited acquired 80%. Minority interest is obviously 20%. Right? Next. Third is what? Analysis of profits of subsidiary company. Now, in the subsidiary company, that is Cool Limited, what are the profits are there, sir? General reserve 84, P&L account 2 lakh 70, securities premium 2 lakh 20. So these are the reserves we have. First, if you analyze P&L account, sir, P&L account balance on 31st March 2024. Can you tell me how much is there? 2,70,000 is the P&L account balance. P&L account balance 2,70,000. On 1/4/23, if you look at the question additional information, they said the P&L account balance is 30,000. So opening balance 30,000. So entire this 30,000 is what's the pre-acquisition profits, because Best Limited acquired Pool Limited on 1st February 2024. This balance is on 1st April 2023. So it is entirely pre-acquisition profits, which is a capital profit. Now that means what is the current year profit, sir? From 2,70,000 reduce 30,000, it will be 2,40,000 is the current year profit. Now this 2,40,000, if I allocate on time basis from 1st April to 1st February, that means 10 months. 2,40,000 into 10 by 12. 10 months profits. 2,40,000 into 10 by 12. 2 lakhs will be what, sir? It is also pre-acquisition category. Pre-acquisition profits, which is nothing but capital profits. And 2 months profits, February, March, is nothing but 40,000, which is a post-acquisition profits. Post-acquisition profits, which is nothing but what, sir? A revenue profit, because parent acquired subsidiary on 1st February. So we analyzed. So this analysis gives a conclusion of there is a capital profit of 30,000, 2 lakhs. Total 2,30,000 is the capital profit, and revenue profit of 40,000. That's it. So one reserve analyze done. Next, general reserve you take 84,000. General reserve 84,000. What they told, sir, this entire general reserve is taken from the last year. Therefore, this is 1/4/2023 balancer, which is nothing but pre-acquisition profits, which is nothing but capital profit. So entire general reserve 84,000 is a capital profit, pre-acquisition profit, nothing but. Okay. So another capital profit is 84. Now coming to securities premium also, sir. Securities premium 2,20,000, nothing, no information given, sir. So securities premium, what is the amount, sir? 2,20,000. This is also entirely pre-acquisition profits, which is nothing but capital profit. So capital profit, this is also 2,20,000. Okay. So I think we have done proper analysis, sir. Now once the analysis is completed, next one is what, sir? Apportionment. Apportionment of profits. Whatever the subsidiary company profits are analyzed, sir. Next thing is we need to apportion them. Kindly apportion. How we are going to apportion? Simple. First, pre-acquisition profits, post-acquisition profits. Pre-acquisition profits are capital profits, post-acquisition profits are revenue profits, revenue reserves. Now first take P&L account. In P&L account, 2,30,000 is capital profit. Take it here. And 40,000 is a revenue profit. Take it here. And then general reserve entirely capital profit, 84,000. Then P&L account, not P&L, already analyzed. Securities premium, next. Securities premium also 2,20,000 capital profit. So it will be 2,30,000 plus 84 plus 2,20,000. 5,34,000 is the capital profit. 40,000 is the revenue profit. Revenue reserve nil. Now it will be shared between Best Limited 80% and then minority interest, right? Minority interest is 20%. So 534,000 into 80%, it will be 427,200. 1,06,800 will be minority interest. 1,06,800. 40,000 into 80%, it will be 32,000 here. 8,000 will be here. Okay. So I think we have done proper apportionment also. Now once apportionment is over, next step is what, sir? Step number 5. Minority interest. One of the elements they have asked, sir. How to get minority interest? Minority shareholders share in the net assets of subsidiary companies, sir. In the here net assets is share capital plus reserves and surplus. So from the subsidiary company, what is the share capital? 20 lakhs, sir. On that 20%. 20 lakhs into 20%, I think 4 lakhs we will take here. And also here we need to add minority shareholders share in the pre-acquisition profits. What is their share? 1,06,800. Take it. Post-acquisition profits, what is their share? 8,000. Take it. Okay. But here one important thing, sir. Unrealized profit is there. Unrealized profit on stock. See here, subsidiary company sold goods to parent company before consolidation, before acquisition. 5 lakhs cost of goods sold at 6 lakhs 50. So 1,50,000 profit is there in the subsidiary company books. That profits only. This P&L account includes that profit also. So we analyzed and apportioned. That means this unrealized profit is already apportioned between the parent and minority shareholders. But we have to eliminate it now because this profit is unrealized, not yet realized. Within the group only the stock is there. It is not went outside. That means whatever the profit included in the sales, in the stock, 1,50,000. In that 1,50,000, what is the profit which belongs to minority shareholders? 20%. 30,000. Eliminate it. So now you will get minority interest. Sir, this treatment already we have discussed classroom elaborately, sir. You watch the concept once, you will understand. 4,84,800 is the minority interest. See this. Minority interest 4,84,800. Got it? So one thing we have done correctly. So only with this analysis and apportionment you can arrive this. Okay. Now once you got the minority interest, what is step number 5, sir? Step number 5 is cost of control step. Cost of control step is also very important step, sir. In cost of control, we need to compare first cost of investment. What is the cost of investment, sir? Here in this case, 14,80,000. Any pre-acquisition dividend? Nothing. This we need to compare with the parent company share in the net assets of the subsidiary company on the date of acquisition, which is represented by what? Share capital plus reserves and surplus. What is the share capital of the subsidiary company? 20 lakhs. In that 80% share belongs to parent. That is 16 lakhs once. And also, what is the parent company share in the subsidiary company on the date of acquisition? That is nothing but pre-acquisition profits, which we already done in step number 4. In step number 4, you see in the pre-acquisition profits, this is step number 6, sir. Okay. In the pre-acquisition profits of the subsidiary company, parent company share is 427,200. Take it. 427,200. Okay. Next, that's it, sir. 14,80,000 minus 16 minus 427,200. So it will be 547,200, sir, minus, which is nothing but what, sir? Capital reserve. Capital reserve. When the cost of investment is more than the net assets, it is goodwill. If it is less than that, then it is a capital reserve. 5,47,200, sir. But here, sir, in the suggested answer which is given by ICA, what they have done is they have got 427,200, sir. Sir, why they got 427,200? Because here the unrealized profit, actually you see Purchase consideration, they considered 14 lakh 80. We also considered 14 lakh 80. This 16 lakhs, yes, we considered. Pre-acquisition profits, we considered 427 200. But securities premium 80%, general reserve, opening balance of the P&L account on that 24. This they forgot to write here, sir. Actually, 2 lakh 70 minus 30 into 10 by 12 into 80%. It will be 1 lakh 60 actually. So 14 lakh 80 minus 16 minus 1 lakh 76 minus 67 200 minus 24 minus 1 lakh 60. It will be 547 200. And this they have considered this also minus 40. So actually here they have taken wrongly, sir. And see, unrealized profit on the stake, they cannot adjust here when they are calculating cost of control step. If you remember our classroom discussion, unrealized profit is adjusted in the step number 8, reserves for consolidated balance sheet. This is one mistake, sir. So you follow this. This is correct answer. 547 200. Okay. 547 200. We got it, sir. So that means out of the steps, minority interest done, sir. Cost of control done, sir. Now they are asking trade payables. So here once step 6 is done, next is step number 7, sir. What is this step number 7? Intercompany owings. Important, sir. Intercompany owings, what we need to do is, first you consider trade payables, sir. Trade payables, if I considered in the Best Limited, 3,80,000 is there. And from the Cool Limited, how much is there? 4,10,000. But between both the companies, Cool Limited point of view, there is a bills payable now. That we need to eliminate. Because Cool Limited bills payable, Best Limited parent company bills receivable, both will be eliminated. So bills, in the form of bills, there is an intercompany owings of 3 lakhs. Eliminate it. So 3 lakh 80 plus 4 lakh 10 minus 3 lakhs. It will be 4 lakh 90,000. I think first bit answer 4 lakh 90, sir. Yes, this see this. Best Limited how much? Cool Limited how much? How much is the intercompany owings? Eliminate. This is very simple. Now coming to current assets consolidation. See, when you do the current assets, sir, same. First take the current assets, sir. When it comes to current assets, sir, what is the Best Limited? 965. And 5 lakh 60. And see, this bills payable for Cool Limited, bills receivable for Best Limited. So in the Best Limited current assets of 9 lakh 65, this 3 lakhs is already there. This we need to eliminate. Because intercompany owings means one company liability, another company asset. So in the subsidiary company liability 3 lakhs is there. In the parent company assets, current assets 3 lakhs is there. Both will be eliminated. So 965 plus 5 lakh 60 minus 3 lakhs. It will be 12 lakhs 25,000. 1225. See this. Yeah, one more important adjustment I forgot, sir. Unrealized profit. Unrealized profit we need to eliminate from stock also, na, sir? Yeah. 1,50,000. Because here in this case, we need to eliminate unrealized profit from the stock value as well as this unrealized profit which is included in the subsidiary company books that already analyzed and apportioned. So we need to eliminate from the parent company reserves as well as the minority interest. So minority interest already we have done it. Now in step number 8, we need to eliminate from the parent company reserves also. So it will be 10,75,000. Correct. 1075. Correct. So 10,75,000 is the current assets. So we got it. So step 1 and 2, the requirement 1 and 2 also done. Next, step number 8, reserves for consolidated balance sheet. Balance sheet. If you look at the parent company reserves, we have general reserve as well as P&L. So take it. P&L, general reserve. What is the P&L account? 3,26,000. And what is the general reserve balance? 2,69,000. Now for this, what we need to do? Add parent company share in the post acquisition profits of the subsidiary company, which is step number 4. Step number 4, you go and check what is the parent company share in the post acquisition profits. Post acquisition profits, parent company share is 32. So add 32,000. And also adjustment, unrealized profit on stock, which is already included because subsidiary company profits are analyzed and apportioned. So in this 2 lakhs, 80% share, not 2 lakhs, I think profit is 1,50,000. 5 lakhs worth of stock sold at 6,50,000. So 1,50,000 into 80% profit. So 1,20,000 we need to eliminate from the parent company. So eliminate it. So you will get 326 plus 32 minus 1,20,000. So it will be 2,38,000. And this will be 2,69,000. But if you look at the ICI answer, sir, see this. In the P&L account, they have considered only 3,58,000. Why? Because they have not reduced this unrealized profit. Unrealized profit they have eliminated in cost of control step, which is wrong, sir. Here we need to eliminate unrealized profit, sir. That unrealized profit of 1,20,000. Here we need to eliminate. Okay. So this is what we have learned. So they have considered wrongly. So 2,38,000 is the answer. This is consolidated P&L account. Next, general reserve consolidated 269, which is we got it. So that means out of the requirements, we also got this one, this one. Now next, revenue from operations consolidated. Revenue from operations means sales, nothing but 56 lakhs, 38 lakhs. So 56 plus 38, so it will be 94. And there is a intercompany sales purchases is there, na sir? That we need to eliminate. See this. So revenue of Best Limited 56, revenue of Cool Limited 38 lakhs. Important. In this 38 lakhs is for total year, na sir? We need to consider only 2 months. Okay. And also cost of metals purchased consumed also same. What is the raw material of Best Limited? And in the Cool Limited raw material consumption, take 2 months only because post acquisition, pre acquisition we will not consider. Now subsidiary related everything is done, sir. Now associates, relating to associates, they're asking us on acquisition of good limited shares, what will be the goodwill or capital reserve? Simple, sir. Same way. How we done cost of control steps, same manner, is 23. First we need to consider what is the cost of investment for acquiring this 25% shares in Good Limited, 3,80,000. Now what is the parent investing company share? Share capital. Share capital is 10 lakhs. On this 10 lakhs, 25%, 2,50,000. And also no securities premium. General reserve 1,20,000. On this 1.2 lakhs, 25%. $30,000. And also you take P&L account 50,000. Sir. On this 50,000, 25%. 12,500. So 3,80,000 minus 2,40,000 minus 30 minus 12,500. So it will be 87,500 goodwill. So 87,500 goodwill, sir. Say this, 87,500 goodwill. So cost of investment is this much. Share capital, general reserve, P&L account. What is the share? So cost of investment is more than this. So it is a goodwill. That's it, sir. So this is how they are asking, sir. So once you solve questions relating to AS 21 and then come back and solve, very simple, sir. So this is question number 2. Next, question number 3 from supplementary material in consolidation chapter. This question is previous exam question, sir. May 2024 attempt question for 14 marks. Let us see the facts of the question. See, there are two companies, sir. Arc Limited, Craft Limited. Their balance sheets given on 31st March 2024. Equity and liability side, shareholders fund, current liabilities, asset side, non-current assets, current assets. Now in the notes to accounts, they have given a breakup of share capital. 6,500 shares of 100 each fully paid up in Art. In Craft, 4,000 shares of 100 each fully paid. Reserves and surplus, general reserve, P&L account is there. Short-term borrowings, we have bank overdraft. Property, plant, equipment, land and buildings, plant and machinery is there. Non-current investments, investment in Craft Limited. Art Limited has invested in Craft Limited. So in the individual balance sheet of Art Limited, asset side, we have investment in subsidiary company Craft Limited. Okay. Cash and cash equivalents, cash. Okay. Cash balance given. So look at the additional information, sir. Arc Limited acquired 3,200 ordinary shares of Craft Limited on 1st October 2023. See, the date of acquisition is 1st October 2023, sir. The Arc Limited acquired 3,200 shares of Craft Limited. Out of 4,000, sir. Actually, in the Craft Limited, we have 4,000 shares total. 3,200 divided by 4,000 into 100. So that means 80% shares, sir. So definitely control interest has been acquired. So parent subsidiary relationship came. So we need to follow AS 21 for consolidation purpose. Now the reserves and surplus and P&L account of Craft Limited showed a credit balance of 40,000 and 58,700 respectively on 1st April 2023. See this. The date of acquisition 1st October 2023, date of consolidation 31st March 2024, and they have given opening balance of reserves and surplus in the subsidiary company. That means these are helpful for analysis and apportionment of subsidiary company reserves. So this is the first one, sir. Next, sir, the plant and machinery of Craft Limited, which stood at 2,50,000 on 1st April 2023, was considered worth 2,20,000 on the date of acquisition. Revaluation of assets, sir. There is a plant and machinery in subsidiary company, sir. 2,50,000 is the balance at the beginning, 1st April 2023, which was considered 2,20,000 at the time of acquisition. Okay. The depreciation on plant and machinery is calculated at 10% on the basis of useful life. The revaluation of plant and machinery is to be considered at the time of consolidation. Okay. We know whenever there is a revaluation at the time of consolidation, the revaluation surplus we need to consider as capital profit, pre-acquisition profits or pre-acquisition losses. And because of the revaluation of the assets, any additional depreciation, any savings in depreciation, that has to be adjusted with the post-acquisition profits. Okay. That point we need to see. And also you see, Craft Limited deducts 1% from trade receivables as general reserve against doubtful debts. This policy is not followed by Art Limited. Actually, in study material, we have one question, sir. When the subsidiary company accounting policies are not uniform with the parent company accounting policies, we need to revise the financial statements of the subsidiary company and then we need to consider it for consolidation. So same thing here. Here, the subsidiary company following one policy of deducting 1% from trade receivables as general provision, but this is not followed by parent company. Therefore, what we need to do, the subsidiary company financial statements has to be revised as if there is no such policy. Okay. See, you solve the supplementary questions only after completing the classroom questions, whatever we have, because otherwise they will reduce your confidence. The thing is that these are examination questions. You must feel confident that yes, I can able to solve them. Only that is possible if you complete the classroom discussion and thoroughly you know the concept. Okay, because in point number 2, this concept is relating to revaluation of assets. This already we have done. We have solved some questions also in the classroom. So if you directly come to these questions, it might be very difficult for you. So revaluation already happened, and this one also, there is one question I have explained in the classroom, which is there in the study material, that subsidiary company accounting policies are not in accordance with the parent company. Then we revised the financial statements of subsidiary and then considered for consolidation, same thing. And also fourth point, you see on 31st March 2024, Craft Limited inventory includes goods which it had purchased from Arc Limited for 1,03,500, which made a profit of 15% on cost price. See, intercompany transactions, sir. 31st March 2024, sir, in the books of Craft Limited, subsidiary company, there is goods which is purchased from the Arc Limited, sir, 1,03,500, which made a profit of 15% on the cost price. Therefore, I need to eliminate unrealized profit from the stock, sir. Okay, and this is downstream transaction because parent company sold goods to subsidiaries. You are required to prepare consolidated balance sheet. So 4 important adjustments are there. Now you know how to approach the question. See, this question is May 2024 examination question relating to accounting standard 21 consolidation. So first step number 1, date of acquisition. I think 1st October 2023 is the date of acquisitions. Second, shareholding pattern. Shareholding pattern on the date of consolidation 31st March 2024. What will be the shareholding pattern, sir? I think the parent company Arc Limited is having 80%. Minority interest, minority shareholders is having 20%. Okay. Then the third one, analysis of profits of subsidiary company. This is very, very important, sir. Come to the subsidiary company reserves and surplus, sir. General reserve, P&L account, 2 reserves are there. Now first take the general reserve. General reserve balance on 31st March 2024, 40,000 is there given. And if I want to analyze this properly, in the additional information, if you see, they have given 1/4/2023 the balance. See this. The reserves and surplus of and P&L account of Craft Limited showed a credit balance of 40 and 58,700. 40,000 is already there in the beginning itself. That means current year appropriation is nil, sir. Actually, current year appropriation is nil because this 40,000 is came from opening only. Okay, so therefore this entire 40,000 is what, sir? This is pre-acquisition profit, can I say? Because I acquired subsidiary on 1st October 2023. So these are already there at the beginning. So these are pre-acquisition profits, which is nothing but capital profit. So this 40,000 is a capital profit. So one thing done. Next, to come to the P&L account, 31st March 2024. So what will be the P&L account balance, sir? P&L account balance is 2,08,000. 2,08,000. Now if you see the P&L account balance at the beginning, 1/4/2023. At the beginning, the P&L account balance in subsidiaries 58,700. 58,700. That means this is what pre-acquisition profits. Pre-acquisition profits, which is nothing but capital profit. Okay. Now the most important, what will be the current year profit then? Tell me. 2,08,000 minus opening 58,700. It will be 149,300. 149,300. And if you observe carefully, sir, from April to October pre-acquisition period, from November beginning to March of the next year is post-acquisition, right? So this is pre, this is post. No, sir, I think small mistake. April to September, sir. September. April to September, one category, sir. September to March. Sorry, September not. October to March. October, November, December, January, February, March. 6 months. So 6 months, 6 months. So 149,300 74,650, 74,650, because we acquired on 1st October 2023, sir. So first 6 months pre-acquisition, next 6 months post-acquisition. So 74,650, 74,650, done. But what changes has happened during the year? Important, sir. Revaluation happened, sir. When revaluation happened, sir? On the date of acquisition, 1st October. I told you whenever revaluation happened at the time of consolidation, for consolidation, that will be treated as pre-acquisition profit. Now here you consider there is a plant and machinery 2,20,000. See this. Revaluation, we can do separately also, nothing wrong. Revaluation profit. You know, plant and machinery balance on 1/4/2023, how much, sir? 2.5, 2,50,000. Now if I reduce 6 months depreciation, that is 2,50,000 into 10% depreciation for 6 months. So it will be 12,500, sir. So that means what will be the book value on 1st October? It is 237,500. But what is the revalued amount? They have done a revaluation, right? So the revalued amount is how much? 2,20,000. So therefore 17,500 is what, sir? Revaluation loss. That's it. Revaluation loss, sir. 17,500 is the revaluation loss. Because 2,37,500 worth of asset, they have considered 2,20,000. 17,500 is a revaluation loss. So this we need to consider it what? Pre-acquisition profit, which is nothing but capital profit. This we know. And also one more thing, sir. Since you have done a revaluation and you have reduced the asset value to 2,20,000, now 2,20,000 into 10% for 6 months, this should be the depreciation. 11,000 should be the depreciation, but depreciation is actually provided on 2,50,000, right? So 2,50,000 into 10% for 6 months. If depreciation is provided like this, 12,500 is the depreciation. So depreciation actually provided 12,500. Depreciation to be provided as per the revised 11,000. So therefore 1,500 is what, sir? This is excess depreciation provided. If excess depreciation is provided, our profits has been come down. Now we need to add back. So therefore, for this post acquisition profit, I need to add back this 1,500 excess depreciation. See, same type of questions we have solved. 2 questions from the study material also there. So see this. Whenever revaluation happens, sir, that revaluation profit or loss will be pre-acquisition profit. Accordingly, it will be a capital profit or capital loss. And because of the revaluation, the future depreciation got affected. Either additional depreciation may come, or whatever the excess depreciation provided, you need to reverse it back. Here excess depreciation, we need to reverse it back, that is 1,500. So add back, because my post acquisition profits have been got down. Now add back. And also, sir, in the question, if you see one more important thing, sir, this one 1% provision against trade receivables. Actually trade receivables given in the question is how much? See this, 168,300, sir. 168,300. 168,300. So 168,300, 1% provision. So if I make it for 100, what will be the amount? Tell me. 168,300 into 100 divided by 99. It will be 1,70,000. So 1,700 you provided provision. Because of that, my profit got down. So now I need to add back. But see, this 1,700 is for the entire year. So divide by 2. So 850 I need to add back for pre. 850 I need to add back for post. You understood? Actually, provision created by the subsidiary, but that provision should not be there because parent company is not following that. So therefore, whatever the provision you created, because of that profits came down. Now you need to add back that provision to profits. How? Total 1,700. Pre 850, post 850. Okay, so 74,650 plus 850, it will be 75,500. So this is also what, sir? Pre-acquisition profits, which is a capital profit. Now the next one is 74,650 plus 1500 plus 850. So it will be 77,000, which will be post-acquisition profit, which is a revenue profit. I think we have analyzed the profits of the subsidiary company. Now, once the analysis is completed, the most important thing is apportionment. Apportionment. Once the profits were analyzed, the analyzed profit has to be apportioned. How they will be apportioned, sir? Pre-acquisition profits or capital profits, post-acquisition profits or revenue profits, revenue reserves. Now coming to capital profits, first take general reserve. General reserve 40,000 is the capital profit, sir. Take here 40,000. Next, revaluation profit. We have done it. Revaluation profit or loss. Sorry, revaluation loss we got. Anyways, revaluation loss. How much? 17,500, which is also pre-category. 17,500. And also P&L account, if you see P&L account. In the P&L account, pre-acquisition category 58,700 plus 75,500. Total 134,200. 134,200. And then in the revenue profit category, it will be the balance 77,000. Okay. So whatever the reserves and surplus of the subsidiary we analyzed in a sir, we apportion. So the total pre-category, total post-category. 40,000 minus 17,500 plus 134,200. So it will be 156,700. 77,000. This one. So how we are going to share it? Between the parent, Art Limited, 80%. And then minority interest, 20%. So share it. 156,700 into 80%. It will be 125,360. If it is 20%, it will be 31,340. Similarly, 77,000 into 80%, 61,600. 20%, it will be 15,400. So that's it. So apportionment done. Once the apportionment is completed, then minority interest. How minority interest is calculated, sir? Minority shareholders share in the net assets of the subsidiary company. So first to take the share capital of the subsidiary company. What is the total share capital? 4 lakhs. In that 4 lakhs, 20% belongs to minority shareholders. Apply 20%. So 4 lakhs into 20%, 80,000. Now the minority shareholders share. One by one you take it. So in the capital profit, what is their share? 31,340. In the revenue profit, 15,400. So total it will be 80,000 plus 31,340 plus 15,400. So it will be 126,740 is the minority interest. 126,740. You see, I will show you. Minority interest 126,740. See this 126,740. We got it absolutely right answer. 126,740. And analysis also we have done absolutely right. See this 125,360. We also got same 125,360, 61,600, 31,340, 15,400. Yes, 15,400. So that means we are doing correctly. Next, cost of control step is also very, very important. First, take cost of investment, sir. What is the cost of investment, sir? To acquire the shares of Craft Limited, we spend how much? See here, take from here investment 4,32,000. Any pre-acquisition dividend? Nothing. Less. Parent company share in the net assets of the subsidiary company represented by, in the share capital of 4 lakhs. Here net assets is represented by share capital plus reserves and surplus 80%. And also the capital profits. Step number 4. What will be the parent company share? So 4 lakhs into 80%, 3 lakhs 20,000 we will take, sir, one thing. And also, you know, here parent company share 125,360. 125,360. That's it. So 4 lakh 32, minus 3 lakh 20 minus 125 360. It will be 13,360 minus. So there is a capital reserve. There is a capital reserve, sir. So see this. So 13,360. See this. We got it rightly. 13,360. 13,360 capital reserve. Okay. So once you got this, I think seventh, intercompany owings. So in case of intercompany owings, sir, what happened is subsidiary, there is a downstream transaction. Downstream means what, sir? Parent sold goods to subsidiary. That means Arc Limited sold goods to Craft Limited, sir. Craft Limited. Right? Now the stock is there with whom? Subsidiary company, Craft Limited. How much worth of stock is there? 1,03,500. 1,03,500. Okay. Now, who has booked this profit? Can you tell me? Parent, because the goods sold by the parent company. 1,03,500, which made a profit of 15% on the cost price, sir. See this. So 1,03,500. So what will be the profit included in this? 1,03,500 into 15 divided by 115. Suppose if the cost is 100, profit 15, so it will be 115. So 1,03,500 is equal to 115. How much is for 15? So 1,03,500 into 15 divided by 115. So it will be 13,500 is the unrealized profit. This unrealized profit I need to eliminate from two places. One is parent company consolidated reserves I need to eliminate. Another thing is that from the stock I need to eliminate 13,500 for consolidated balance sheet. Okay. This we already discussed in the classroom, sir. These kind of adjustments. Now step number 8, reserves for consolidated balance sheet. This is also very important step. Reserves for consolidated balance sheet. So parent company general reserve P&L account. So take it. General reserve P&L account. What will be the balance of Arc Limited in the general reserve as well as P&L account? 1,20,000, 1,92,000. So 1,20,000, 1,92,000. Sorry, 192. Now for this we need to add post acquisition profits. Parent company share in the post acquisition profits of the subsidiary company as per step number 4. So come to the step number 4, sir. In step number 4, what is the parent company share in the post acquisition profits? 61,600. So take it 61,600. This 61,600, I think it is relating to profits. Okay. And also, sir, unrealized profit, which is goods sold to subsidiary company, right? Unrealized profit is there now, 13,500 minus it. That's it. So 1,20,000 and also 192 plus 61,600 minus 13,500. It will be 2,40,100. And also, sir, in the consolidated balance sheet, cost of control step we got 13,360. So that will also we need to consider, sir. So therefore, the total reserves for consolidated balance sheet, see this, total reserves and surplus, it will be 3,73,460. How they got it? See this. P&L account 2,40,100, correct? So general reserve 1,20,000, I think, right? Next, capital reserve from cost of control step 13,360. That's it now. So I think all the steps done. Now we need to prepare the consolidated balance sheet. So reserves and surplus, step number 8, I got it. We solved. Minority interest, step number 5, we have done it. Minority interest. Remaining and all just line by line addition, sir. That's it. And inventories, when you consider inventory, Arc Limited, Craft Limited, any unrealized profit, you reduce it. That's it. Remaining and all just line by line addition. Most important things we have already done, sir. This is the workings. And you see, for example, first share capital. How much will be the share capital, sir? As a parent company, what will be the share and we need to consider the share capital of the parent company, 6 lakhs 50. That is what. Reserves and surplus already done. Next, minority interest done. Current liability, short-term borrowings add. Parent as well as subsidiary. Trade payables add. Non-current assets, property, plant, equipment add both. Inventories add minus unrealized profit. Trade receivables add. Cash and cash equivalents add. So remaining items and all just a line by line addition. Main focus will be on what, sir? Reserves for consolidated balance sheet. And for that, this much working you should do, sir, because if you don't analyze the profits properly and if you don't apportion them, obviously minority interest will be wrong, cost of control will be wrong, and reserves for consolidated balance sheet will also be wrong. And these are the important steps, sir. If you these things, if you done properly, remaining and all just line by line additions. So this is question in the consolidation from the supplementary. This is previous year paper May 2024 examination questions, sir. That's it. Now see question number 4, sir, from supplementary material, consolidation chapter. This question relating to AS 23, sir. Consolidation of associates. See this question, sir. There is a company A Limited invested 1 lakh rupees to acquire 10% stake, which is investment number 1 in B Limited, and later invested rupees 3 lakhs to acquire additional 20% investment 2. The net assets value of the B Limited at the respective investment dates are 7 lakh 50, 12 lakh 50 respectively. Determine whether B Limited is an associate of A Limited. Also calculate goodwill arising on the acquisition of associates. Sir, AS 23 says when a company will become our associate when we have significant influence. How can we achieve this significant influence? Directly or indirectly by having shares. 20% minimum. See, in this case, investment number 1 10%, sir. Investment number 2 20%. So which is obviously more than 20 or more. So there is a significant influence. So we will become associate of A Limited. That is for sure. Now they are asking us to calculate the goodwill also, which we will do. Simple. How to calculate goodwill or capital reserves, sir? Compare your cost of investment with the share in the net assets. That's it. So as per AS 23, an associate is an enterprise in which investor has significant influence and which is neither a subsidiary nor a joint venture. Significant influence may be gained by ownership, statute or agreement. As regards share ownership, if the investor holds directly or indirectly through subsidiaries 20% or more of the voting power of the investee, it is presumed that the investor has significant influence unless it can be clearly demonstrated that this is not the case. In this case, A Limited has invested 30% in B Limited, so B Limited would be considered as an associate of A Limited. Now, how to calculate goodwill here? First, you see 1 lakh is the cost of investment, right? And when you acquire the first investment, what is the share in the net assets of the B Limited, sir? 7 lakh 50. 7 lakh 50 into 10%, so 75,000. So therefore, your cost of investment is 1 lakh. Share in the net asset 75. The excess amount is goodwill 25,000. Investment 2. The cost of investment is how much? 3 lakhs. 12 lakh 50 is the net assets into 20%. 20%, sir. 2 lakh 50,000. So 3 lakhs minus 2 lakh 50. So 50,000 is what? Goodwill. Excess. So therefore you see here on the first acquisition, excess amount 25 we invested. Investment is more than the share in the net asset. Second, 50,000. So total it is 75,000. The total goodwill. Very simple question. Now see question number 5, sir. This question is also relating to AS 23, sir. There is a company Hill Limited which has a share capital of 50,000 shares of 100 per share. Sun Limited acquired 15% shares in Hill Limited on 1/4/2024. Okay. It also acquired all the 5,012% convertible debentures of 100 each of the Hill Limited. These debentures will be converted at par into equity shares of Hill Limited after 3 years. State whether AS 23, as per AS 23, Hill Limited is an associate of Sun Limited. See, here Sun Limited acquired 15% shares in Hill Limited. And then it acquired all debentures. Debentures will not give you controlling interest, ownership interest. In order to call any company as our associate, we should have significant influence. That is minimum 20% share capital. Here we are having only 15% in shares. 12% we are having in convertible debentures. They are potential equity shares. Whether potential equity shares will also be considered for calculation of the 20%? No. So therefore, here Hill will not become associate of Sun Limited. Okay. So because Sun Limited is still having 15% only. Potential equity shares are not to be considered. See this. As far as the ownership, if the investor holds directly or indirectly through subsidiary 20% or more of the voting power of the investee, it is presumed that the investor has significant influence unless it can be clearly demonstrated that it is not the case. Conversely, if the investor holds directly or indirectly through subsidiary less than 20% of the voting power of the investee, it is presumed that the investor does not have significant influence unless such influence can be clearly demonstrated. Okay. Further, as per, okay, for the purpose of classification of associate, the potential equity shares of the investee held by the investor will not be taken into account for determining the voting power of the investor. See this. The potential equity shares of the investee held by the investor will not be taken into account for determining the voting power of the investor. In other words, the voting power should be determined on the basis of current outstanding securities with voting rights. Sun Limited presently holds indirectly 22.7% with and without voting rights in Hill Limited. However, the current outstanding securities with voting rights is only 15%. Remaining holding is on account of potential equity. Sir, how we got this 22.7? See, they are adding this one also. This 7,500 shares, and in future, suppose those debentures, 5,000 debentures, potential equity shares, if they converted into equity shares, so I may have this much. So 22.7, but which is not the case, right? You should not consider potential equity shares for calculation of the 20%. Since potential equity shares do not have voting rights, they will not taken into consideration while determining the significant influence of Sun Limited on Hill Limited. Hence, Hill Limited is not an associate of Sun Limited. So this is also one important question we have covered. So question number 4 and 5 relating to ACE 23.